Now, considering doing an illustration in the remaining time, December 2023, question 2B. December 2023, question 2B. Scotts Limited has experienced stockouts occasioned by the company's poor inventory estimation techniques. The company has therefore engaged you to estimate its demand for the year 2024. The company's accountant had started using regression analysis and availed the following information to you. The demand for the company's products is dependent on disposable income and price of the products. Number 2, the analysis of variances table. The analysis of variances table, we have a source of analysis, you have model, there is error, another column there is degree of freedom, and sum of squares. Number 3, the parameters estimates, the parameter estimates and the errors. 1, we have a column there for variable, estimate, and standard error. We have constant, we have price and price. Required: develop a regression equation that will be used for prediction. Roman 2, determine the coefficient of determination. Interpret your results. Roman 3, test the adequacy of the model for prediction. F table's value is 11.56. It was quite direct, this one. It was quite direct. Develop a regression equation. First of all, you have to put down the regression equation, then you insert the inputs. Multiple linear regression allows one to determine the effect of more than one independent variables on a particular dependent variable. So there are more than one, multiple predictors. Multiple predictors. So Scotts Limited has experienced stockouts occasioned by the company's poor inventory estimation techniques. The company has therefore engaged you to estimate its demand for the year 2024. The company's accountant had started using regression analysis and availed the following information to you. Number 1, the demand for the company's product is dependent on disposable income and price of the products. Number 2, the analysis of variances table as shown. ANOVA, that is the ANOVA, the analysis of variance. We have the degree of freedom, that is model, source. Then there is the error. Then you have total. Number 3, the calculations have already been done, candidates. So we have almost almost everything that is required. You can see that the sum of squares is given. The sum of squares is provided. That's why I say the question was quite direct. Then number 3, the parameter estimates and their errors. There are 3 columns there. Variable, let me confirm something. This is question number 2B. So we need to change candidates. There was an error there. You can see not in number 3. Number 3, I was to confirm that because of the repetition. That last price there is income, not price. the parameter estimates. The parameter estimates, that is income. That's what disturbed my mind. I had to confirm from the original paper. So the values are okay. So that total, we have 3 plus 9, 12, 187 plus 4, it's 191. So develop Roman 1, we have to develop regression equation. Develop regression equation. Develop regression equation. December 2023, question 2b. This is December 2023, question 2b. Roman 1. What is the requirement? Regression equation. We have independent variable y being equal to beta naught plus beta 1 beta 1 beta 1 x1 plus beta 2 x2. So how many variables do we have here? How many variables do we have? Give me, how many variables do we have? How many variables do we have? These are 2. All right. Plus error. So we check from the question. Do we have beta naught? The intercept. Look at the question. Look at note number 3. Note number 3. We have the constant. Look at the constant. The parameters, the estimates and their errors. We have this constant 1.1 represents the intercept 1.5 plus beta 1. Our beta 1, look at the question, candidates. Look at the question. Look at the question. Look at the question. We read, note number 1, the demand for the company's products is dependent on disposable income. So the dependent variable is y, and it is dependent on disposable income and price of the products. So there are 2 dependent variables. That is the price and income, dependent on disposable income and price. So we have income and price. From note number 3, you can see the price is 1.5, negative 1.4. That is the price, negative 1.4. So we have plus negative 1.4 x1. Then the next dependent variable is the income, and the income is 5. We have 5 x2 plus error. Y is equal to 1.5 minus 1.4 x1 plus 5 x2 plus the error term. Then note number 2, what is what are we required to calculate? Determine the coefficient of determination, then interpret the results. Now, what is the coefficient of determination? Now, the coefficient of determination is the R squared. The coefficient of determination in cost estimation is the R squared. And it is a statistical measure that indicates the proportion of the variance in the dependent variable cost. It indicates the proportion of the variance in the dependent variable cost that is explained by the independent variables or the cost drivers in the regression model. And we know it ranges from 0 to 1. It ranges from 0 to 1. So if you have R squared of 0, that means that the model explains none of the variation in the dependent variable. Alright? But you have R squared of 1, then the model explains all the variations in the dependent variable, all the variation. That what is the formula for R squared? Coefficient of determination. Roman 2, coefficient of determination, often abbreviated as R squared. R squared. So what is the formula for R squared? Now the formula for R squared is equal to SST. That should be R first. SSR over SST. SSR over SST. SSR over SST. SSR R over T. SSR over SST, where SSR is the sum of squares due to regression. Sum of squares due to regression. Then SST is the total sum of squares. The total sum of squares. Do you see that? SSR is the sum of squares due to regression. Sum of squares due to regression. We divide by the total of squares. The total of squares. Total of squares. Total of squares SST. This represents total. This is regression. Sum of squares due to regression divided by the total of squares. So what is a SSR? Look at the question. SSR. Look at the question. SSR. Now look at note number 2. The analysis of the variance. Note number 2. Note number 2, the model. Look at model, the sum of squares. Can you see that? We have the sum of squares, then you have the error. So the sum of squares is given at 187 and the total is 191. So this is equal to 187 over 191. The total is 191. 191 is the total. Now give me the r squared. Should be 0 point something. It is 0.98. This is the r squared. And we've said that the coefficient of determination is a statistical measure that indicates the proportion of the variance in the dependent variable cost that is explained by the independent variables, which are the cost drivers in the regression model. The cost of determination, r squared, indicates the proportion of the variance in the dependent variables that is explained by the independent variables, and it ranges between 0 and 1. So you can see this one is 0.9, it is close to 1. And I did say earlier that if the r squared, if the coefficient of determination is 0, that tells you, that indicates that the model explains none of the variation in the dependent variables. But if it is 1 or close to 1, the model explains all the variation in the dependent variable. So a higher r value indicates a better model fit. A higher coefficient of determination, in other words, suggests that the model is more accurate in predicting the cost. It suggests that the model is more accurate in predicting the cost. So we've calculated the coefficient of determination in this question that was tested in December 2023. The coefficient of determination is 0.98, which is close to 1, which means that approximately 98%, because 0.98 is just 98% when converted into percentage. That tells you, that means, and now I'm interpreting, that approximately 98% of the variance in the demand can be explained by the independent variables. That is the price and income, because those are the independent variables. Interpretation. Because candidates were required to give an interpretation of the r squared of 0.98. 98% of variance in demand. 98% of variance in demand, because demand, candidates, is the dependent variable in this question. So 98% of the variance in demand can be explained by the independent variables. Can be explained by the independent variable. But if it was to be 0, then that means that it could not be explained. If it's 0, the model explains that none of the variation independent variable. The model explains none of the variation. But if it is 98%, which is close to 1, then it means that 98% of the variance in demand can be explained by the independent variables in this question. These are the price and income. Price and income in the model. Price and income are the independent variables in the model. It indicates a strong explanatory power of the regression model. That is the interpretation. And that is part 2. Part 3 of the question reads, test the adequacy of the model for predicting or for prediction of F tables value 11.56. Now, to test the null hypothesis, candidates, that all the slope coefficients in the multiple regression model are jointly equal to 0 against the alternative hypothesis that at least one slope coefficient is not equal to 0, we must use an F-test. So the null hypothesis is that all the slope coefficients in the multiple regression model are jointly equal to 0. That is the null hypothesis. But we need to carry out the test. And we know the F-test is viewed as a test of regression's overall significance. The F-statistic measure. The F-statistic measures how well the regression equation explains the variation in dependent variable. In other words, candidates, this one is just a ratio of the mean regression sum of squares to the mean squared error. So we need to calculate the F statistic. So what is the formula for F? F calculated. It is a ratio. Mean regression of some squares. This is equal to mean regression of some squares. Just two things. The mean regression of some squares and the mean squared error. We divide it by the mean squared error. Which is equal to, first of all, we need to calculate the mean regression of some squares. The mean regression of some squares will be equal to RSS over K. We divide that fraction by another fraction, SS. This should be SSE. SSE. We divide it by N minus K plus 1. N minus K plus 1. Or simply, it can simply be just MSR we divide by MSE. The F statistic, where RSS is regression sum of squares. Regression sum of squares. Regression sum of squares. Mean regression of some squares. Alright? Regression sum of squares. And K, we are dividing this by K. K is the number of independent variables in the model. Number of independent variables, and in our case there are two. It was what was it? There are two You have price and income, independent variables. This is number of independent variables. Then you have k plus 1. K plus 1 is the total number of parameters to be estimated. How about SSE? Now, SSE is the sum of squared errors. The sum of squared errors, all right? SSE is the sum of squared errors. And the N, of course, is the total number of observations. So we are dividing with k and k plus 1 so that we can get the mean. It's just the same thing, candidates, to get this mean in the first statement. So we are dividing with k here and n minus k so that we can get the mean. So it is just the mean regression of sum squares minus mean squared error, and this is the formula for mean regression of sum squares. This is the formula for mean squared error. So there are two things, the mean regression of sum squares and mean squared error. These are the formulas for the two. You understand? Is that clear? Let's move to the third one here. We're just trying to expound and look at it from different perspectives. Now, MSR is the mean regression of sum squares. Mean regression of... Do you understand? MSR is the mean regression sum. The mean regression sum of squares. MSE is just the same thing, candidates, here. MSE is the mean squared error. So let us land. We are now landing, candidates. We have to calculate the F statistic. F calculated. So from the question, we have these values. Look at the question. Look at the question. Do we have the values? RSS. What is our RSS? RSS is 187. You see that? 187. The sum of squares is 187. It has already been calculated. So just insert the input. That is 187 divided by 2. 187 RSS you divide by 2 over our SSE. SSE is the sum of squared errors. We have the sum of squared errors from the question. Sum of squared errors. Yes, the errors you can see there, the sum of errors from the table is 4. Then we divide by n. What is our n? Our n from the analysis of variances. Yeah, the total there is 12. Degree of freedom, that is 12. All right, that is for 12. So we have 4 divided by n, which is 12, minus k, we know is 2 plus 1. That's it. Give me the F calculated. F calculated. F statistic. How much is it? F calculated. Give me the F calculated. F calculated is equal to Sarah. I'm waiting for F calculated. Is it greater than 11.56? The F table, the F tables give me the F calculated. Johnny says 210.375. 210.375 is the S calculated. What does that mean? Or what are we required to you do with that? Test the adequacy of the model. That's the question. Test the adequacy of the model for prediction. So to test the adequacy of the models of prediction, where the F table's value is 11.56, we have to first calculate the F calculated. And the F calculated, we see here, and this is more than the 11, is it 11.56? Yeah, the F calculated, and this is the test. F calculated is greater, is it not? Is it not greater than the F tables? The F calculated of 210.375 is greater than the F tables of 11.56. What that does mean? Here we reject the null hypothesis that all the slope coefficients in the multiple regression model are jointly equal to 0. We reject the null hypothesis that all of the slope coefficients in the multiple regression model are jointly equal to 0. Remember, that's what we said at the beginning. And that means that the regression model is adequate for prediction because the calculated F statistic, the calculated F, is significantly larger than the critical F value tables. And that is to say, that is to mean that the model provides a statistically significant explanation for the variation in the demand, because the demand, we know, is the dependent variable. It is the dependent variable. The total cost in this question depends on the price and the income, which are the independent variables. So a larger F statistic, which is the calculated statistic, we've seen is significantly larger, because we are talking about 210.375 being larger than the 11.56. It is significantly large, as was the case for the coefficient of determination, which was 98%. 98% of variance in demand explains that the independent variable, it can be explained, okay, by the independent variables, that is price and income, and therefore the model provides a statistically significant explanation for the variation in the demand. So that is what was required for that question that was tested in December 2020. 2023. Any question? Thank you for attending the lesson. Bye-bye.
Hi there, my name is Patrick Kamau Kamure, and I welcome you today to our lesson where we continue looking at the tax planning. You can see it's a continuation from our previous lesson where we started looking at the tax planning for the individuals and especially those in employment. And by the end of that lesson, after looking at various opportunities available to a person under the employment, we say that this lesson we are going to look at a question. So I'll read the question, then we see how we can solve the question. So here I read. Peter Samoei is an employee of Zawadi Limited and earns a salary of 140,000 per month, while his wife Sabina Wanga works in Lindi Limited, a firm in which Mr. Samoei controls 18% of the share capital. Her salary is shilling 60,000 per month. Sabina Wanga owns the house which is occupied by the family, for which the market rental value is shillings 45,000 per month. The house was constructed in the year 2017 at a cost of 6 million, borrowed from Masako at an interest rate of 12% per annum. Sabina Wanga has insured the house and paid insurance premium of 4,800 per month and city county rates of 6,900 per annum. Mr. Samoei paid insurance premium for his family of 4,600 with an insurance company incorporated in Uganda but operating in Kenya. Zawadi Limited paid school fees of 8,000 for the couple's children, which was expensed in the firm's income statement. Required suggests 4 tax planning scheme that could minimize the tax liability of the family. So we are supposed to suggest 4 tax planning scheme that the family can use to legally reduce the tax they are supposed to pay, because that is what tax planning is about. So if you look at the question, let's go item by item. We spot an opportunity, then we indicate how it can be utilized. Peter Samoei is an employee of Zawadi Limited, earning a salary of 140,000 per month. There is no opportunity there. While his wife, Sabina Wanga, works in Lindi Limited, a firm in which Samoei controls 18% of the share capital. There we have an opportunity. We said if the wife works in a company where the husband controls 12.5% or more of the shares, the wife income is added to the husband income to be taxed together. But when it is less than 12.5%, it will be taxed separately, and in which case both of them will claim personal relief, and also the wife income will be taxed at graduated scale rates. So we put that down. So we had reached up to the second sentence. Now we continue. Her salary, now the wife, is 60,000 per month. Sabina Wanga owns a house which is occupied by the family, for which the market rental value is 45,000 per month. The house was constructed in the year 2017 at the cost of 6 million, borrowed from Masako at an interest rate of 12% per annum. Sabina Wanga has insured the house and paid insurance of 4,800 per month and county rates of 6,900 per annum. So there is another opportunity from that point of the wife owning a house which she constructed through a SACCO loan. Now, in this case, remember, SACCO loan do not qualify for mortgage interest relief. Remember, we say that an opportunity available to an employed person is to use the mortgage interest relief to reduce the taxable income and eventually the tax to be paid. So what should she do, because it's not a mortgage? She should take a mortgage loan and use it to pay the SACCO loan. And now she will remain with the mortgage loan, in which case now she can claim the mortgage interest relief to be used to reduce the taxable income and eventually the tax payable. and we are going to show the amount, which we said is the lower of interest on the loan and the 25,000 per month or 300,000 per annum, whichever is lower. So what we are saying is that the wife, Sabina Wanga, should take a mortgage loan and use it to pay the SACCO loan so that she can qualify for mortgage interest relief to be used to reduce the taxable income and eventually the tax payable. With the lower of 12% per annum of the mortgage, that is now the interest, which is 720 for the whole year, and the limit, which is 25,000 per month times 12 for the whole year, 300,000. In which case we get the lower to be 300,000. Now we continue. The second paragraph, Mr. Samoei paid insurance premium for his family of 4,600 with an insurance company incorporated in Uganda, but operating in Kenya. So there is another opportunity, family insurance cover, that is life insurance cover. So if it is outside Kenya, a company outside Kenya, one cannot qualify for the insurance relief. So he should shift it to a Kenyan company so that now he can be able to claim the insurance relief to be used to reduce the tax payable. With the lower of 15% of the premium he is paying, and we compare with 5,000 per month or 60,000 per annum, whichever is lower. So number 3. So that's what we are saying. Mr. Samoei should transfer the family insurance cover from a company incorporated in Uganda to a company incorporated in Kenya so that he can claim insurance, insurance relief to be used to reduce tax payable with the lower of the interest, 15% of the premium, of which case, since we are not told whether it's per month or per year, we assume it's per month so that we multiply by 12 to get for the whole year. And we compare with the limit, which is 5,000 times 12, 60,000 per year. The rest is that one. So we look at the last part of the question. The last part which we are told, Zawadi Limited paid school fees of shillings 80,000 for the couple's children, which was expense in the firm's income statement. Now, we had said that if the company expensed the school fees in the income statement, it is a taxable benefit on the employee. And since now we are advising the employee how he can reduce the tax liability, is we advise him to request the company not to expense the school fees in the income statement so that it will become a tax-exempt benefit on him. So number 4. So if you look at the required, we were supposed to suggest 4 schemes, and the 4 schemes we have provided. So that is how you are supposed to answer that question. That is one question. I'd like us to look at another question to see how we can answer it. This is what the question says. Albert Kimeri is an employee of Ruaka Limited. He has provided the following information relating to his income. Number 1, he earned basic salary of shillings 60,000 per month. He is paid house rent allowance of shillings 30,000 per month. His wife Ravena Kimeri is employed at a salary of 54,000 per month with Tops Limited, where Kimeri hold 20% of the shares. Now, number 4, they both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. The employer paid school fees for the children of Albert Kimeri. He was a member of a unregistered pension scheme where the employer made contribution towards the scheme on his behalf. The wife ran a farming business where she earned 400,000 from the sale of farm produce. He is contemplating securing a bank loan for his children education or an education insurance policy that will equally cater for their children's education. We are required to suggest a tax planning that will minimize the tax liability of the family of Mr. and Mrs. Kimeli for the year of income and the subsequent years. So in this case, we go through the question one by one, analyzing for any available opportunity. We start with number one. He earned a salary of 60,000 per month. There is no benefit or opportunity that can be utilized there. Number two, he is paid house rent allowance of 30,000 per month. Again, there is no opportunity that can be utilized there. His wife, Ravena Kimeli, is also employed at a salary of 54,000 per month with Tops, where Kimeli holds 20% shares. Like we said in our previous question, reducing the shareholding to less than 12.5% so that the wife is tax separated from the husband, so that both can enjoy 2 personal relief and the wife income can be taxed at graduated scale rate. So solution. So what we are saying is that Albert Kimeli should reduce shareholding at Tops Limited, where the wife worked to less than 12.5% from 20%, so that they are tax separatory in order to enjoy 2 personal relief and for the wife income to be taxed at graduated scale rates. So we were in point number 3. So we now go to point number 4. They both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. Now, we are not told that the borrowed funds is mortgage loan. So, borrowed funds does not mean mortgage loan. So, we should advise, like the other one, that the wife should take a mortgage loan and pay the borrowed funds so that she can claim the mortgage interest relief to be used to reduce the taxable income and eventually the tax to be paid. So, number 2. Now, since we haven't been told how much the fund was, we just state. Yeah? So, the wife, Ravena Kimeli, should take a mortgage loan and use it to pay the borrowed funds in order to qualify for mortgage interest relief, to be used to reduce taxable income with the lower of mortgage interests and also 25,000 per month or 300, whichever is lower, to be used. We continue. That was point number 4. We go to point number 5. The employer paid school fees for the children of Albert Kimeli. There is another opportunity there that Kimeli should request the company not to expense the school fees in the income statement so that it will become a tax exempt benefit on him. So number 3. So Albert Kimeli should request the company not to expense the school fees in the income statement so that it will become a tax exempt benefit on him so that he's not charged tax. So that was point number 5. We go to number 6. He was a member of unregistered pension scheme where the employer made contribution towards the scheme on his behalf. Now, there's another opportunity there. Employer contributing to an registered pension scheme, it will become a taxable benefit on him. So he should join a registered pension scheme so that when the employer contributes for him, it will become a tax exempt benefit. So we put it down. So Albert should join a registered pension scheme so that when employer contribute for him, it will become a tax exempt benefit. As at the stand now, it is a taxable because it's unregistered. We continue. Number 7, the wife runs a farming business where she earns 400,000 from the sale of farm produce. For that one, there is no benefit one can derive out of that. So that one we ignore. 8, he is contemplating securing a bank loan for his children's education or education insurance policy that will equally cater for the children's education. So the best opportunity is to take an education insurance policy so that he can claim the insurance relief to be used to reduce the actual tax payable instead of a loan. And we say that with the lower of 15% of the premium or 5,000 per month or 60,000 per annum, whichever is lower. So we are saying that Albert should take an education insurance cover instead of a loan for the children education so that he can claim insurance relief to be used to reduce tax payable with the lower of the 15% of the premiums or 5,000 per month or 60,000 per annum, whichever is lower. So that one, or that's how you answer the question involving the tax planning for the individuals. So there are some questions that you are going to do given after this video, so you can use them and test yourself. For today, we are going to stop there until I see you in the next lesson, where we look at the tax planning for the limited company. Thank you very much.
Hello and welcome to this session of Advanced Excel Formulas. In this session, we are going to cover formulas that are related to the if statements. If statements are advanced formulas that are normally used when you want to analyze your data and come up with formulas that will give you certain criteria. And with me here, I have created a workbook that will enable us to go through a variety of if statement formulas that are in use here. The first one that we are going to tackle will be the if statement formula. Now, if statement is a formula in Excel that helps in analyzing the contents of a single cell, and it analyzes the contents of a single cell and compares it against a condition that you've specified or a condition that you've stipulated. If the contents of the cell that you are analyzing surpasses the condition that you've set, then the formula will give you a true value, a true statement, or a true formula. But if the contents that you are analyzing don't meet or don't surpass the condition that you stipulated, then the formula will give you a false value or statement. So let us go straight to how the if statement is applied so that we can be able to see what happens if we use the if statement formula. So with me, I have come up with data that we are going to use. This is the student's grade sheet. It has column A through to column E. There is student name, there is the age of students, the exam score, there is age status, and there is grade. So we have a grade here. And first, we are going to look at the age status. And you can see the age status, we've stipulated a condition. There are conditions that have been stipulated here. Now for age, if the content or the cell that we're analyzing surpasses 20 as the condition, then the formula will give back youth. But if it is less than 20, the formula will give us teen. So if it is greater than, we can use greater than or equal to 20, the formula will return youth. But if it is less than 20, the formula will return teen. So let us see how that is to be done using the if statement formula. First, we are going to precede every formula with an equal sign. So every formula is preceded with an equal sign. Then we type if, then double click on, you can see if checks whether a condition is met and returns one value if true and another value if false. So I'll double click on the if. Then you click on the value that you are testing, the logical test, the value that you are testing here, which is 34. So B4, where there is age, so 34. We are analyzing 34. We are analyzing 34. So if that cell, which is B4, and it represents 34, is greater than, so we are going to look at a condition that you've stipulated. If that is greater than or equal, now the condition is 20, we type 20. Now if B4 is greater than or equal to 20, comma, then the formula should give you youth. So the youth is going to be put in bracket in quotations. So full quotation, youth. Then you close the quotation. But if that is not met, then the formula should return teen. So the formula should return teen, and we are going to have the teen there. So if before the cell that you are analyzing is greater than or equal to 20, the formula will return youth. Otherwise, if that condition is not met, the formula will return teen. So teen is going to be there. You close the bracket, and after closing the bracket, you hit enter, and it returns that this person is a youth. You can see the person is a youth because the age is 34. 34 is greater than 20, and therefore the formula returns youth. Once that has been done, you copy your formula down up to where Tonet Meg is, and the rest will be pre-filled. Now, Lewis is a youth. David Jack is a youth. Cheryl is a teen. Of course, the age is 18. Gary Hall is 15 years. That one is a teen. We have another youth here. Of course, everything has been brought by your formula or the formula that we entered. So if the age is greater than 20, the formula returns youth. But if the age is less than 20, the formula returns teen, as it has been seen in the if statement formula. Now again, we also have exam score, and we are going to analyze the exam score using the condition that have been stipulated here. Now the condition is that if somebody scores greater than or equal to 60, the formula will return pass. But if somebody scores less than, this one should be less than. If somebody scores less than 60, the formula should return fail. So how is that particular formula applicable? So equal sign, then if, then you double click on the if. You click on the cell that you're analyzing, in this case you're analyzing 80. 80 is C4. So instead of clicking, you can just write C4. That is if you know the cell that you're analyzing, comma. If C4 is greater than or equal to 60, the condition is 60 here, 60, comma, then the formula will return pass. So pass should be in quotation. The formula should return pass. You close the quotation. Otherwise, the formula should return fail. So if the condition above on the left is not met, the formula should return fail. And fail should also be in quotation. So fail should also be in quotation like that. So after that, you hit enter, and the formula, of course, has some error. So we see where the error is. So if C4 is greater than or equal to 60, comma, the formula should return a pass. Otherwise, the formula should return fail. So let us see where the error in the formula is. And okay, so the formula is going to be redone. So if C4 is greater than or equal to 60, comma, then the formula should return pass. You close that, comma. If that is not the case, the formula should return fail. So the formula should return fail. Then we close the bracket and we punch enter. Let us see where the error is. C4 greater than or equal to, okay, so the comma was there after C4, then enter. Now it comes back. So we were putting the formula in just after C4, which was wrong. So if you miss a quotation, if you miss a comma, or if you miss where to place anything, the formula will give you errors, which is what we've encountered in our just concluded errors that happened there. So if you punch enter, then pass. That means if you score 80, the formula will return pass. Let us copy the formula down using the autofill here. So you click on the bottom right side of the formula, then drag it down all the way to Tonet Meg. So the rest, everybody who scored above 60, the formula returns pass. Anybody above 60, the formula returns pass. Anything below that, fail. Like Cheryl failed, got 50. Gary 40, that one failed, all the way to 72 here, that is Vim, who scored 72, and that is a pass. So that is how the if statement is applicable in analyzing whatever data that you have in terms of what we've seen here. So the formula can be applied in a variety of ways. You can use it to be able to determine whether your sales were high or they were low sales, or whichever any other analysis that you want to come up with. So that is the if statement. We now want to move to the second analysis, which is nested if. So on our other sheet, we have nested if, which we want to go to and analyze how different things can be done now using the nested if statement. Now, nested if statement, just like the if statement, it analyzes the contents of a single cell. It analyzes the contents of a single cell and compares it against a given condition, and compares it against given conditions. So it analyzes the contents of a single cell, but compares it against given conditions, compares it against given set of conditions, and it returns a true value or statement if the tested condition is met. Otherwise, it will be returning a false value or statement if the tested conditions are not met. So the nested if statement, it analyzes the contents of a single cell and compares the contents against several given conditions, so that it returns a single value statement or formula if one of the condition is met. Otherwise, if no condition is met, then it returns a single false value statement or formula. That is the nested statement here. So in this case, we want to analyze the grades of students on this student's grade sheet. And with me here, I have the students' names. There is Cat 1, there is Cat 2, there is Assignment 1, there is Assignment 2, there is presentation that was done, there is an exam that was also done, then there is total, then there is analysis for grade 1, and also analysis for grade 2 in that particular order. So first, we want to get the total. Remember, for you to get the total, it has to be the summation all the way from Cat 1 to exam. And the best formula that we can use here is AutoSum. You can see AutoSum. You just click on sum and it predicts that indeed you want to sum everything on the left. So that is AutoSum. Then you punch enter. Or you can say sum. Then you double click on the sum. Then you just highlight what you want to sum up to exam. Then you close your bracket then you punch enter. That is the same thing. Anyway, I want to drag the formula down so that the rest of the answers can be pre-filled. Then I want to reduce this to 1 decimal place. 1 decimal place, which means I'll decrease the decimals here. You decrease the decimal so that it's 1 decimal place. Then there is grade 1, there is grade 2, and there is the conditions that we want to follow here. So you can either come up with A, B, C, D, E, or from distinction through fail. If a student scores above 75 or equals to 75, the formula should return grade A or distinction. If a student scores 60 or above, the formula should return either B or credit. If a student scores 40 or above, the student should return C or pass. If a student scores 30 or above, the formula should return D or refer. If a student scores 30, less than 30, if a student scores now less than 30, if a student scores less than 30, that one is to be changed, then that should be an E or fail. So we'll start A through E for grade 1, then distinction through fail for grade 2 here, using the nested if statement. The only difference between nested if statement and the if statement is that for if statement, there is only one condition. But for nested if statement, you'll be comparing the contents of your cell against several given conditions. So straight to the formula, you precede your formula with an equal sign. Then if, double click on the if. So if the cell that you're analyzing is where the totals are, if that is 23 here, H4, which is 23, is greater than or equal, the condition is 75, so greater than or equal to 75. If H4 is greater than or equal to 75, then comma, this formula should give you A. So you type A, then close it in the quotation marks, then comma. Again, if, again you double click on the if, the same H4, which is 23, is greater than or equal to, the other condition was 60, greater than or equal to 60, comma, then the formula should give you credit. So the next one there was credit. Then that one is also enclosed in the closing bracket, then comma. If the same cell, H4, formula is missing an opening here. So if, then we double click on the if H4, the same cell, is greater than or equal to 40, greater than or equal to 40, then the formula should give us C. So we're going to type C in quotation, so that will be C. Then you close the C like that. I missed here, so this ought to have been D. So I'm going to correct this to D. There is A, not B, but B, A, B, C. Then now we move. Again, if H4 is greater than or equal to 30, comma, the formula should return or give us a D. So that one is a D there. We close. But now we are on the last one. We have A, we have B, we have C, we have D. Now for the last one, there is no need of starting with if again. You just come up with the comma, then you bring the quotation. Of course, it assumes that whatever has been said already is not met. Then whatever follows will be E. That is what, if what is on the left is not met, then the formula should just give you E straight away. So if you don't need to be in the category of A, B, C, or D, then you'd be in the category of E. Then you close the brackets depending on the number of brackets that are open. So how many brackets are open? 1, 2, 3, 4 brackets are open. You're going to close ours with, again, 4 brackets. So 1, 2, 3, 4. After that, you hit enter and it will give you that the first person indeed scored an E. So you can see our formula here, the way it has been typed on the formula bar, and that is what is expected of us to do. So you copy it down and the rest will just appear. A few people have gotten E's, others have gotten A, like 80 is an A, 43 is a C, 62 is a B, 39 is a D, all the way to 24 being an E, 85 is a, we have C's, and we also have other D's there. So this is the score after analyzing these particular grades using the if statement formula. Again, we want to analyze the same thing, but now where there was an A or E or D or C, we are going to replace with distinction, credit, pass, refer, and fail in that order. This was 75. This was 75. Let me see if that was 75. It is correctly put. So again, we want to now replace with the distinction through to fail using the same formula. So equal sign, if, then you double click on the if. If the cell that you're analyzing is this 23 where there is total, that is E4, if that is greater than or equal to 75, comma, then the formula should give us distinction. The formula should give us distinction. The formula should give us distinction. Comma, if, again double click on the if, the same cell is greater than or equal to 60, comma, then the formula should give us credit. The formula should give us credit. So you enclose, comma, then again, if the same cell is greater than or equal to 40, then the formula should give us that was if it's greater than, that was pass, comma, then again, if the same cell is greater than or equal to 30, comma, the formula should give us refer. The formula should give us refer. You close the bracket, then the last one automatically, comma, then you bring in, the other one is fail. The other one is fail. The other one is fail. Then you close with the number of brackets that are open. 1, 2, 3, 1, 2, 3, 4. That is 1, 2, 3, 4. So you're going to close with the 4 brackets. 1, 2, 3, 4. I hope all the brackets have been presented, and that one is a fail for that particular student. So this one had everything. There was 30, there was 40, yeah. So once that is pre-filled, you copy your formula down again, and let us see if it is corresponding to the way we needed. So you can see E is fail, A is distinction, C is pass, B is credit, C is pass, B is credit, D is refer, E is fail, A is distinction again. So this is how you analyze your data using if statement and also using nested if statement. So that is if statement and nested if statement.
Hello and welcome, candidates. We are moving on well with the topic on leadership and strategic change. The subject is leadership and management. In today's session, we will take on a new subtopic, which is diagnosing the change context. Diagnosing the change context. Now, candidates, how change is managed is dependent on the magnitude of the challenge faced in trying to effect strategic change, and is therefore useful to consider the type of change required, number one. It's also important to consider, number two, the wider context in which change is to occur. The third thing to consider is the specific blockages to change that exist, and lastly, the forces that exist to facilitate the change process. Four important things. Number one is the type of change required. Number two, the wider context in which change is to occur, the specific blockages, and also the forces that exist to facilitate the change process. In our today's session, we're going to study the types of strategic change and how to carry out diagnosis. Now, candidates, it's also important to indicate that strategy development is often incremental in nature. Strategy development is normally incremental in nature. It builds on rather than fundamentally changes, or it builds on something rather than fundamentally coming in to change the status quo. So strategy development is in most cases incremental, and therefore, candidates, we're going to draw here a matrix that is going to help us to understand the types of strategic change. We're going to have a diagram here, and types of change, let me call it types of change. Types of change. So here on one hand, we'll have what we call extent of change. Extent of change. The extent of change. Then we're going to have nature of change. On the other side, nature of change. So here we'll have realignment, two columns, realignment and transformation. Realignment and transformation. Realignment and transformation. Then you're going to have incremental, big bang. Big bang. We are going to use this matrix to illustrate the types of change. The types of change. So we have the extent of change and the nature of change. Now, candidates, the nature of change is concerned with the speed at which change happens. The nature of change is concerned with the speed at which change happens. And we have two columns here. That is incremental. Remember, we say that normally change is incremental. Then the big bang, that is, in other words, fundamental. All right. And also the extent of change, on the other hand, candidates, it is important to note something on the nature of change, that it is beneficial for change in an organization to be incremental. And what is the reason? Because it allows time to build skills. It allows time to build maybe routines. It also allows time to change beliefs in an organization. However, it should be noted that if an organization faces a crisis or needs to change direction very fast, then the big bang is the approach to take. The big bang is the approach to take. So, we will now try and see, let me use my ruler here, candidates. We're going to see, we've said that the nature of changes is concerned with the speed at which change takes place, this extent at which, the extent to which, or the speed at which change takes place. And I'm repeating a third time that normally change is incremental, and it is preferable that change should be incremental because it takes time for individuals to change beliefs, to change skills, to change routines, because with strategic change there may be need to have the employees to change their skills, to change their culture, to change their beliefs, and so on. But that is beneficial that it be incremental. But there are certain situations where change, in times of crisis, where change may need to be fundamental, all right? What we are calling here the big bang, the big bang, all right? The big bang. So when change is incremental and the extent of change that may require realignment, then what we'll have here in the first box is adaptation. Now, candidates, adaptation is change that can be accommodated within the current culture. Adaptation, number one. Adaptation. This is change that can be accommodated within the existing culture. It is a change that can be accommodated within the current or existing culture, and it occurs incrementally. This kind of change is most common in organizations. It is done what? It is what? It's most common in organization. Then in this other matrix, we have what we call reconstruction. Reconstruction. Now, candidates, reconstruction is a type of a change that may be rapid. Number two, reconstruction. Reconstruction. This is type of change that may be rapid because of the big bang. It may be what? It may be rapid, and it may involve a good deal of upheaval in an organization, but which does not fundamentally change the culture, but does not fundamentally change organizational culture. It may be rapid, but does not fundamentally change the organization's culture. That is reconstruction. It's another type of change. Then there is the revolution. This is we have evolution here. and revolution. These are change, revolution. Number 3, revolution. Revolution. Now, candidates, revolution is change that requires rapid and major strategy as well as culture change. It is rapid and requires major strategy. It is rapid and requires major strategy. That is the revolution. All right? And this could be in circumstances where the strategy has been so bounded by the existing culture that even when environmental or competitive pressures might require fundamental changes, the organization has failed or may have failed to respond. And that might have occurred over many years and resulted in circumstances where pressures for change are extreme. For example, situations like takeovers, which can threaten the continued existence of the company. The fourth type of change is evolution. Evolution, number 4, evolution is another type of change. And candidates, evolution is change in strategy that requires culture change. This one requires culture change. Evolution requires culture change, but over time, from the word evolution. Evolution, to evolve. Evolve requires culture change, but is not rapid. Rather, it requires time. And in some respects, this is the most challenging type of strategic change. Why? Because for many in organizations, for many people in organizations, there may be no pressing need for change. There may be no pressing need for change. That is a challenge with this kind of type of change. So candidates, that is the types of change. Remember, we are doing the diagonizing of the change context. Diagonizing of the change context. If you recall, candidates, at the beginning, I said that how change is managed will depend on the magnitude of the change faced in trying to effect strategic change. I also said that it is useful to consider the type of change required. It is useful to consider the wider context in which change is to occur. It is also important to consider the specific blockages to change and forces that can facilitate change. Then we've, in this lesson, gone ahead to explain 4 types of strategic change based on these 2 axes, that is the extent of change and the nature of change. And candidates, we've said that strategy development is often incremental in nature. Why? Because it builds rather than fundamentally change prior strategy. In most cases, companies do not come up with the totally new transformative strategies, but they build on what has existed. So the big bang or the fundamental change is less common in organizations. So in this session, we've come up with 4 types of strategic change that can be identified and that could have implications on how change might be managed. And we say that the nature of change is concerned with the speed at which change happens, and arguably it is beneficial for change, we've said, in an organization to be incremental,
because it allows employees to change culture, to change skills, to change beliefs, to change routines, and so on. But we also mentioned that if an organization faces a crisis or needs to change direction very fast, then the big bang approach is the way to go. And combining these two, we've come up with 4 types of change. The first one being adaptation, where we've said that this is where change can be accommodated within the existing culture, adaptation. The second one is reconstruction. We say that reconstruction may be rapid, but does not fundamentally change organizational culture. The third type of change is revolution. We've said revolution is rapid and requires major strategy, whereas evolution, it requires culture change, but over a longer period of time. So thank you for attending our today's session where we discussed recognizing the change context. Thank you. God bless you. Bye-bye.
Hello, welcome back to this revision session. We are still on the August 2022 setting of advanced taxation. So in this session, we shall answer question 2 of the paper. Question 2A is a mathematical question. So have your calculator and other materials ready, and let's go through the question together. It says, Bell Limited, a small-scale retailer, operates 2 sales outlets, one at the head office and the other at the branch. For the year ended 31st December 2021, the following results of the head office and the branch were presented to you. So we have an income statement for the head office. We also have an income statement for the branch. So the income statement starts from gross profits. They have other incomes for the year. They have expenses, and then the net profit reported for the year. Now the topic being tested here is taxation of, advanced aspects of taxation of business income. Advanced aspects of taxation of business income. So under that we have several subtopics. We have taxation of companies. We have taxation of specialized institutions like banks, like contractors, like insurance companies, and all that. So that reminds you to have a look at that topic keenly and be able to answer the questions correctly. So I want us to go through the additional information one by one and be able to understand the effect of each on our computation. So additional information 1 says, goods worth 600,000 shillings were transferred from the head office to the branch at 10% below the normal selling price. First of all, you should understand that a branch of a company is not an independent taxpayer. Now, that reminds you about the rules in taxation of groups of companies. Number 1, in case of a group of companies, that is a parent company having subsidiaries and all that, each member of the group is treated by law as a separate and independent taxpayer. So if, for example, A Limited is a subsidiary of B Limited, then A and B are separate taxpayers. But on the other hand, a branch of a company is not an independent taxpayer. It is part and parcel of the head office. So when determining taxable income of such a firm, we do not separate the branch from the head office. So in this case, in fact, the question requires compute the combined adjusted taxable profit or loss of the year for the year ended that. So we have to combine the income statement of the head office together with that of the branch so that we determine the taxable income or loss of the entire firm. So let's go back to additional information 1. Goods worth 600,000 shillings were transferred from the head office to the branch at 10% below the normal selling price. Now, if you look at the income statement,
we have a gross profit of the branch at 7 million shillings. Now, what is the effect of this? It means, in short, the head office transferred goods to the branch at a price below the normal price. So, in short, the purchases of the branch were underestimated or were undervalued because the branch got these supplies at a price below their normal price. So what is the effect of that? If purchases are undervalued, it means the cost of sales will be undervalued, and so the reported profit will be overvalued. So to correct that, what we shall do is to work out the undervaluation of the purchases of the branch, and then we shall deduct it from the reported profit so that we correct that profit to get the exact performance of the branch. So we shall do that in the course of our computation. 2. 70% of insurance recovery was in respect of stocks destroyed by fire. The balance was on compensation on capital items. Now, if you look at the income statement keenly, under other items, there's what we call insurance recovery under the head office. The branch has none, but the head office has insurance recovery of 30,000 shillings. And we are told in note 2, 70% of that figure was in respect of stocks destroyed by fire. Then the balance was a compensation for capital items. The rule is here. Insurance compensation for loss of revenue items like inventory is a taxable income. But insurance compensation for loss or rather for capital items is not a taxable income. So in this case, what we shall do is short. 70% will be a taxable income, but the remaining 30% being a compensation on capital items will not be a taxable item. So that means this income has been overstated by 30%. So what we shall do is to deduct the 30% of 30,000 so that we arrive at the correct taxable income of the firm. 3. Staff salaries include provision for leave accruals equal to a third of the total salaries for the head office and the branch. Staff salaries include provision for leave accruals equal to a third of the total salaries for the head office and the branch. Now, for tax purposes, expenses are classified into two. We have allowable expenses and disallowable expenses. So in this case, there is this expense in the income statement called staff salaries, the first expense in that income statement. For the head office is 240,000, for the branch is 90,000. Now, the statement is a third of this is staff, is provision for staff leave accruals. Now, for tax purposes, staff salaries are allowable expenses, but provisions are not allowable expenses. So what we shall do is, in short, is to separate the staff expenses and the provision for leave accruals so that we disallow the leave accruals, but we allow for the staff salaries. 4. The interest income recorded in the books of Bay Limited was gross, although Bay Limited received net of withholding tax. The interest income recorded in the books of Bay Limited was gross, although Bay Limited received net of withholding tax. Now, interest income is an investment income. Remember, investment income can be the form of interest income or dividend income. Now, for a company, withholding tax on interest income of 15% is not final tax. So in this case, we are told that the interest income recorded in the income statement were gross, although the company received the net amount, that is net of withholding tax. So what we shall do is simple. The gross amounts are taxable, yes, but when working out the tax liability of the company, we shall deduct the withholding tax on interest already paid by the company to arrive at the correct net tax payable or tax liability of the firm. 5. Bonus shares were from a company where Bell Limited has 30% control. Bonus shares were from a company where Bell Limited has 30% control. So if you look at the income statement keenly again, under other incomes, there is what they are calling bonus shares of 120,000 shillings received by the head office, that is Bell Limited. Now, bonus shares are a form of dividends. You know, there are many forms of dividends that a company can pay. A company can pay cash dividends. A company can do bonus issue of shares. A company can do scrip dividends and all that. Share split and reverse split and all that. Now, in this case, we are told these bonus shares were received by this company from another company where it controls 30%. Now, the rule is for dividend income received by a company from another company in which the receiving company controls 12.5% or more of the voting power of the paying company, then such dividends will not be taxable in the hands of the receiving company. So in this case, Bell Limited is controlling 30% of the paying company. What does that mean? This will be exempt dividends in the books of Bell Limited. So in short, I'm saying the bonus shares received by Bell Limited of 120,000 shillings will not be a taxable income. So we shall treat it so, because it should not be taxed, because it is a form of exempt dividends. 6. Rent, rates and insurance paid for the branch. At the beginning of the year, rent accrued amounting to 24,000, and as at 31st December 2021, rent prepaid was 42,000. These had not been adjusted for in the accounts. Rent, rates and insurance paid for the branch. At the beginning of the year, rent accrued amounted to 24,000, and as at 31st December 2021, that is at the end of the year, rent prepaid was 42,000. These had not been adjusted for in the accounts. Now, if you look at the income statement, there is an expense they are calling rent, rates and insurance paid. Rent, rates and insurance paid. So the amount paid by the head office was 410,000, and for the branch was 110,000. But we are told this did not include the rent accrued at the beginning of the year and the prepaid rent at the end of the year. So what we shall do is simple. We shall adjust the rent rates and insurance account so that we work out the correct amount to be shown in the income statement. We compare that with what is actually recorded in the income statement, and then we shall treat the difference as required. Number 7. The lorry purchased was imported and duty paid was 130,000. This was omitted from the cost of the lorry. The lorry purchased was imported and the duty paid was 130,000. This was omitted from the cost of the lorries. Again, if you look at the income statement, under expenses, there is an item called purchase of a lorry at 3.2 million shillings. Now, purchase of a lorry is a capital expenditure which is disallowable for tax purposes. So we disallow the purchase of the lorry, but we should allow for capital allowance, that is wear and tear allowance. Now, in this case, the purchase price of the lorry, we are told, was 3.2 million shillings, and that excludes import duty of 130,000 shillings. So what we shall do is simple. We shall get the total cost of the lorry, that is the purchase price plus the import duty. Now, for purposes of computing investment allowances, input duty paid on imported machinery is capitalized. That is, it is added to the purchase price so that we get the qualifying cost for purposes of the investment allowance. So what we shall do is simple. Add the 130,000 shillings to the 3.2 million. Use the sum to work out the investment allowance, which should be allowable instead of the purchase price of the lorry. 8. Retrenchment costs analysis. Retrenchment costs. Now, if you look at the income statement again, there is what they are calling retrenchment costs. For the head office, 2.5 million. For the branch, 1.3 million. But we have a breakdown here. Number 1, we have provision for staff gratuity. Now, for tax purposes, provisions are not allowable expenses. So here we are told provision for staff gratuity for the head office 800,000, then pension payments 1.7 million. Now, what we shall do is to disallow the provision for the staff gratuity, then we allow the difference. So for the head office, we shall only allow 1.7 million out of the 2.5. For the branch, we shall allow 800,000 out of the 1.3 million shillings. 9 is about loss of stock. Fire raised down a warehouse where goods are stored before they are transported to the head office and branch. VAT at 16% was included in the stocks destroyed by fire. So if you look at the income statement again, there is what they are calling loss of stock. For the head office at 200,000 and for the branch at 500,000. So we are told this included VAT at 16%. Now we know VAT is not an expense for a farm. VAT is a tax, and taxes are not allowable expenses for a farm. So what we shall do is simple. Work out the VAT part of these figures, then we shall disallow the VAT parts because they are not expenses to the farm. And lastly, 20% of loan interest relates to a loan obtained to finance purchase of shares. 20% of loan interest relates to a loan obtained to finance purchase of shares. Now, interest on loan to purchase shares are not, or rather is not an allowable item for tax purposes. So what we shall do is disallow the 20% of the interest expense. Interest expense from the income statement is, so loan interest is 360,000. So we shall disallow 20% of that. Good, and allow 80%. Required 1. Compute the combined adjusted taxable profit or loss for the year ended 31st December 2021. And 2. Compute the tax payable or refundable for the year ended 31st December 2021 based on your results in A1 above. Now, in this case, we have an income statement already prepared for both the branch and the head office. So it means we are able to use the net profit approach to work out the adjusted taxable income. So we present it like this. The company is called Bell Limited. So we say we are answering question 2A. So we say Bell Limited, taxable income computation. For the year ended 31st December 2021. So we have the head office, we have the branch, then we have total. Show currency, and we can carry 3 zeros to ease in our work. Good. So because we are using the net profit approach, we start with the reported net profit. So we say reported net profit. For the head office is 2,310,000. We are carrying 3 zeros, so we write 2310. This is 4027. We can get the sum of that. So that is 2310 plus 4027. I'm getting 6337. Then we adjust this reported profits by 1, adding back. So we say add back. Now here we should add back 3 sets of items. Number 1, we should add back disallowable expenses which have been deducted according to the statement provided. So we go through the additional information and identify them from there. One, we have note 2. Sorry, no. We have provision for loan for leave accruals. That is note 3. Provision for leave accruals. Provision for leave accruals. So note 3 says staff salaries include provision for leave accruals equal to 1/3. So we get 1/3 of each of the figures. So staff salaries is the first expense in the income statement. Head office is 240, so we get 1/3 of 240. 240 divided by 3, I'm getting 80. For the branch is 90, 1/3 of 90 is 30, that is 110 in total. Number 2, we have the rent rates and insurance. Rent rates and insurance. Rent rates and insurance. We need to run a working for this because of note 6. So we need to run a small working one. I'm doing it here. We are running rent rates and insurance account. Rates and insurance account. So I'm starting with the head office. So we go to note 6 of the question. It says rent rates and insurance paid for the branch. So this is for the branch. It is particularly for the branch. Sorry, not the head. The head office is not affected. It is for the branch. So we are told rent accrued amounted to 24,000 at the beginning of the year. Rent accrued is a liability, so we credit that. So we say balance brought down 24. Then as at the end of the year, rent prepaid was 42. Prepaid rent is an asset, and at the end of the year we should credit it. So we say here balance carried down 42. Then if you look at the income statement, rent paid, rent rates and insurance paid for the branch was 110, which we should debit. So we say bank 110. We balance off the account. This is 110. We work out the balancing figure. That is 110 minus 42 minus 24. 44. So the correct figure to be shown in the income statement is 24. This is what should go to the income statement. But what do we have in the income statement? In the income statement we have 110, to mean that the expense shown in the income statement for rent, rates and insurance is overstated. So to correct that, we should add it back. We should add back the difference. So we do 110 minus 44 is 66. We should show that here because it was an overpayment for rent, rates and insurance. 3, we have loan interest to finance purchase of shares. Loan interest to finance purchase of shares. Talking of note 10. So loan interest in the income statement is 360,000. So we get 20% of 360,000, and that is 72. So we disallow that. We add it back. Next we have note 8. We have note 9, which is about VAT on stock destroyed by fire. VAT on stock destroyed by fire. So if you look at the income statement, Loss of stock was 200,000 for the head office and 500 for the branch. So this includes VAT. So what we do is simple. We exclude the VAT component, that is 16 out of 116 of 200,000. I'm getting 27.59 for the head office. And then we are told fire rest down that where goods are stored before they are transported to the head office and branch. Then for the branch it will be 16 out of 116 times 500,000. I'm getting 68.97. We get the sum of the two, 27.59 plus 68.97. I get 96.56. Note 8 is about retrenchment cost analysis. That includes provision for staff gratuity, which is disallowable. So we write here provision for staff gratuity. For the head office is 800, for the branch 500, a total of 1.3 million. We have note 7. Note 7 is about purchase of the lorry that cost 3.2 million. Then the duty paid was 130, which is exceeded. But purchase of lorry we know is a capital expenditure. We should disallow that, but we shall allow for capital allowance. Purchase of lorry, it is 3.2 million for the head office, which is a disallowable expense. We have retrenchment costs. We go back to the income statement and identify any other disallowable expenses. So we move through the income statement, be very keen, and identify the items. So one, we have staff salaries, which we have dealt with in part 1. We have maintenance expenses, those should be allowable. Preliminary expenses are allowable. Retrenchment costs, we have the analysis which we have taken care of. Rent rates and insurance paid, we have dealt with. We have goodwill written off, that is not an allowable item. So we write here goodwill written off. Goodwill written off is 20,000 for the head office. We have legal and accountancy fee allowable. Depreciation is a disallowable item for tax purposes. We add it back. Depreciation is 180 for the head office, 70 for the branch, 250 in total. Interest on overdue tax is disallowable because it's relating to a tax offense. Interest on overdue tax. 80 for the head office, nil for the branch, 8 in total. We have subscriptions to golf club for directors. Subscriptions to clubs for business purposes are allowable, so we don't have to add it back. We have donations. Now donations can be allowable or disallowable depending on whether they meet the conditions, the required conditions or not. So here we just have donations. We are not told whether this met the conditions or not. So we can go either way. One, we can assume that the donations met the required conditions so that they are allowable. And if they are allowable, we do not add them back at this point. Two, we can also assume that they did not meet the required conditions so that they are disallowable. In that case, we shall have to add them back. So we can make a note and an assumption. So under notes and assumptions, we can write, if we assume, let's assume these donations met the conditions. So we can write under notes and assumptions, one, that donations are assumed to have met the conditions, the required conditions, hence allowable. I repeat, The donations are assumed to have met all the required conditions, hence are allowable. By the way, you should also know those conditions. The conditions are only 4. Number 1, the donations must strictly be in the form of cash. Number 2, the recipient must acknowledge receipt of the donations. Number 3, the recipient must be an institution exempted from tax. That means they should have a tax exempt certificate. And then number 4 is that the donations, the donor must not receive any consideration for the donation. In other words, there must be no consideration for the donation, to mean the donor must not receive anything in exchange for the donation. So if all those conditions are met, then donations are allowable for tax purposes. If not all of them are met, then such donations will not be allowable for tax purposes. So in our case, we are assuming that the donations met all the required conditions, and so they are allowable. So in that case, we don't add them back here. Okay, we continue. Next, we have general administrative expenses. Administrative expenses are allowable for tax purposes, so we don't add them back. We are using the gross net profit approach. Purchase of a lorry is already here as a disallowable expense, but we shall allow for investment allowance. Loss of stock is an allowable expense, but we have the VAT component, which we have added back as a disallowable item. Loan interest we have taken care of in note 10. Yes, note 10. Directors' remuneration is allowable. For a company, directors' remuneration is an allowable expense. Then lastly, we have pension contributions, which should be allowable expense for tax purposes. So up to there, we can now get total disallowable expenses. But in other questions, you could meet other items that need to be added back. So I said at this point, we add back 3 sets of items. Number 1, disallowable expenses which have been deducted according to the statement provided. Number 2, we should add back any taxable items or incomes which have not been taxed according to the statement provided. Then 3, we should also add back any items understating the reported performance of the firm. In our case, we do not have the last 2 sets. So this is all we have to add back. So let's do it keenly and get the correct figure. So I'm on the head office, 2310, 80, 72, 27.59, 800, 3200, 20, 180, and 80. I'm getting 69.59. I move to the branch, 4027, 4027, 30, 66, 68.97, 500, and lastly 70. And that should give me 47.61.97. We get the sum of the two, 69.59. I get 11,531.56. That is the first step. The second step is to analyze the deductions. So I'm continuing from here. We have the head office. We have the branch, and then total. Continuation. So here we say less. What do we deduct? We deduct 3 sets of items again. Number 1, we deduct any non-taxable incomes which have been taxed according to the statement provided. 2, we should also deduct any items overstating the reported profits. And then number 3, we should deduct, any items that, any allowable items or expenses which have not been deducted. So I want us to pick it from there. Number 1, we should have investment allowance on capital expenses. Investment allowance. I want to run a small working too. Now, if you look at the income statement, there was purchase of a lorry. There was a lorry purchase at 3.2 million, which has been shown as an expense. So we disallowed that, remember, under disallowable expenses. And then we have note 7, which says that 3.2 million does not include 130,000 that was import duty paid on the lorry that was imported. So we disallow the cost, but we should allow for investment allowance. So I'm working it here. So investment allowance. So investment allowance on the lorry, that is. So a lorry is a vehicle. Vehicles qualify for investment allowance at the rate of 25% currently. So we shall have 25% of the purchase price, that is 3.2 million, plus the import duty, that is 25% of 3200 plus 130 should be 3330 times 25% gives me 832.5. So we should allow this. This is what we bring here, 832.5. The sum is still the same figure. Good. Other items to be deducted. In the income statement, they are showing bonus shares as an income, and we discussed and agreed that is an exempt dividend which should not be taxed on this company. So we write here bonus shares. Bonus shares. You pick it from the income statement at 120. 120. Next we have insurance recovery. Insurance recovery. On note 2. 70% of insurance recovery was in respect of stocks destroyed by fire. The balance was on compensation for capital items. So the balance is 30%. So we get 30% of 30,000. 30% of 30,000 should be 9,000. So we write here 9. Next we have understatement of purchases for the branch. Understatement of purchases for the branch. In note 1, we are told goods worth 600,000 were transferred from the head office to the branch at 10% below the normal price. So we argue like this. 600,000 in this case represents 90%. So then what is the 10%? We can run it as a small working 3. Working 3, I'm doing it here. Understatement of purchases. So that will be 10 over 90 times 600,000. We work it out. 10 over 90 times 600. I'm getting 66.67. 66.67. That. I move to the income statement again. Under the list of incomes, we have what they are calling gain on sale of land and buildings. Now that is a capital gain which is taxed at a specified rate of 5%. Remember the withholding, the capital gains tax rate is 5%. So that cannot be taxed at the corporation tax rate. So we write here gain on sale of land and buildings at how much? 600 for the branch. Next we have gain on shares sold. Gain on shares sold. 30 for the head office, nil, that is 30. And interest income, we were told in note 4 that they have been stated at gross, though the company received them net of withholding tax. So those are taxable as they are, so we don't deduct them at this point. And up to there, we have analyzed all the incomes, so we can now get the adjusted taxable income. Adjusted taxable income. So we start with the head office. So the adjusted taxable income will be the reported net profit plus the additions less the deductions. So we start like this: 67, 69.59 less 832.5 less 129 and 30. That gives me 5778.09. For the branch is 4761.97 less 66.67 and 600, giving me 4095.3. The sum of this must also be equal to the vertical sum. So we do plus 5778.09. It should be 9,873.39. We can confirm that this way. We do 11,531.56 less 832.5, 129, 66.67, and then 630. I get 9873.39. Good. So that answers part A, Roman 1, the determination of taxable income. Part 2 is asking for tax liability. We can do it like this: tax liability. Now this is a company. Companies pay taxes at the prevailing corporation tax rate. So we shall say gross tax liability is equal to 30% of the adjusted taxable income. That is 9873,390. I'm now bringing in the 3 zeros we had carried. So we have 30% of 9873,390. I'm getting 2,962,017. But remember, we were told in note 4 that the company received the interest income from the finance institutions, net or withholding tax. So withholding tax is already paid on the interest income. So we should bring here, say less withholding tax on interest income. So we go back to the income statement. There were 2 interest incomes. One was from Lex Bank. So we say Lex Bank Withholding tax rate on interest income is 15%. We do 15% of the gross amount. We are told the stated figures here were gross of withholding tax. So this is 180,000. We do it together. We shall have 15% of 180,000, which is 27,000. We deduct that. 2, we have the interest income from Beta Microfinance. So you write here Beta Microfinance. That is 15% of the amount there is 200,000. We do that. 15% of 200,000, I'm getting 30,000. Good. And that is the last one. So the difference between that should give us net tax liability. So we do it like this. We shall have the gross tax liability less the withholding taxes. So 29,62,017 minus 27,000 minus 30,000. I get, just a minute, 2962,017 minus 27,000 minus 30,000. I get 2,905,017, and that becomes the firm's net tax liability for the year 2021. Okay, that is question 2A, computation on taxation of business income. We can now move to question 2B1, 2B Roman 1. It says, a tax agent is an important stakeholder in the alternative dispute resolution ADR process. A tax agent is an important stakeholder in the alternative dispute resolution ADR process. Analyze the roles of a tax agent in relation to the ADR process. So there are two key important terms we should understand here. One is tax agent. A tax agent is simply a person licensed and authorized to handle the tax matters of a taxpayer. And remember, a tax agent could be an individual person or a partnership. So in short, I'm saying a tax agent is simply a person licensed and authorized to handle tax matters of a taxpayer. The other key term here is ADR, alternative dispute resolution. And now ADR is simply a dispute resolution mechanism outside the normal court processes, outside the normal judicial system. Basically that. So we are asked to analyze the roles of a tax agent in relation to the ADR process. Now, they are numerous. I'll explain the required number. Now, we can say the following are the roles of a tax agent in relation to the ADR process. The following are the roles of a tax agent in relation to the ADR process. Number one is to apply for the ADR in consultation with the taxpayer. Now, if a taxpayer has an issue which they wish to have resolved through the ADR process, then they have to apply for that hearing. And so this can be done by the tax agent on behalf of the taxpayer. So in relation to the ADR process, number one, a tax agent can apply for the ADR process in consultation with the taxpayer that they are representing. Number two is to attend the ADR meetings on behalf of the taxpayer. Now, one of the requirements in the ADR process is that the taxpayer must be present either in person or through their agents. And so where a taxpayer is an agent, then such an agent may attend the ADR processes on behalf of the taxpayer. 3 is to prepare and submit all documents required during the ADR process in consultation with the taxpayer. In an ADR process, it may be a requirement that certain documents be presented before the ADR proceedings, normally by, or rather chaired by a facilitator. So in that case, to argue for and on behalf of the taxpayer, the tax agent has to prepare and submit such documents to the ADR proceedings on behalf of the taxpayer. Number 4 is is responsible for performing any duty or obligation imposed by the tax law on the taxpayer, including submission of returns and payment of taxes required during, or rather required or resolved to be paid by such a taxpayer during the ADR process. In short, I'm saying this tax agent has the responsibility of performing any duty that the tax law imposes on the taxpayer, such as payment of taxes and required penalties as resolved by the ADR proceedings. And we can add more, advise the taxpayer on the ADR processes to ensure adherence to compliance, to the guidelines and timelines set by the ADR agreements. So in ADR processes, there will be agreements on how to go through the ADR process. So there will be guidelines and timelines set to hear the case. So in that case, the agent will advise the taxpayer on the ADR rules and processes so that the taxpayer adheres to the guidelines and timelines as agreed through the ADR proceedings. So those are some of the roles of a tax agent in relation to the ADR process. Key things to pick from there: number 1, know everything about a tax agent. Know who a tax agent is, obligations of a tax agent, know about qualifications of a tax agent, know about the licensing of a tax agent, and the roles of a tax agent in various tax issues, such as and including ADR. Lastly, part B of question 2 says, explain the circumstances under which the commissioner may cancel the license of a tax agent. Still touching on a tax agent, explain the circumstances under which the commissioner may cancel the license of a tax agent. Now, a tax agent must be licensed by the commissioner before they can serve a taxpayer as their agent. For a tax agent to be licensed, number 1, they must apply for that particular application. Number 2, they must receive a recommendation from what we call tax agent committee, and so on and so forth. So a tax agent can never practice until they are licensed to do so by the commissioner. Now, this license issued to a tax agent may be cancelled in certain circumstances, and that is now what the question is. So we have to explain the circumstances under which the commissioner may cancel the license already issued to a tax agent. There are many reasons, the circumstances under which this may happen. Number 1 is where, sorry, we can introduce that just to be organized. We can say the commissioner may cancel the license of a tax agent under the following circumstances. The commissioner may cancel the license of a tax agent under the following circumstances. Then you can go ahead and explain those circumstances. 1 is where the tax agent assists the taxpayer to evade taxes. Now we know tax evasion is a criminal tax offense, and if you are found guilty of tax evasion, and if a tax agent assists a taxpayer to evade taxes, then the tax authority may punish that tax agent through cancellation of their practicing certificate or license. 2 is where the tax agent fails to notify, where the tax agent fails to notify the commissioner as required under Section 22(1) of Income Tax Procedures Act. So Section 22 1 requires the tax agent to notify, rather to inform the commissioner of certain issues affecting the taxpayer in relation to taxes they should pay. So where the tax agent fails to do that notification, or to give that notification to the tax authority, then their punishment could include cancellation of their license. Another one is failure to pay all prescribed fees during application and renewal of practicing license. Now, this license issued to a tax agent must be renewed after a given period of time. So where a tax agent fails to renew or even to pay the relevant fees prescribed for this, then the commissioner may cancel their license. Another one could be cessation to carry on the business of a tax agent and fail to notify the commissioner within the required time. Now, if you are licensed to serve a taxpayer as their tax agent, then you cease to do that business, you cease to offer that service, and you do not notify the commissioner about that cessation, then that is an offense under tax law. And so one of the punishments you may receive from the commissioner is the withdrawal or the cancellation of that license. Another one is where the tax agent takes advantage of the taxpayer's lack of technical knowledge about tax law. Now, in taxation, we have what we call ethical guidelines for tax practitioners, where a tax agent is a member. Now, some tax practitioners may really take advantage of the ignorance of the taxpayers and, loot their resources or, get undue benefits from them for themselves from such a taxpayer. Now, where it is determined by the commissioner that a tax agent has taken advantage of the ignorance or lack of technical knowledge of the taxpayer, then the commissioner may withdraw or cancel the license of such a tax agent. And lastly, is recommendation, where there is a recommendation to cancel such a tax agent's license by the tax agent committee. We said that for a tax agent to be licensed, they must receive a recommendation from the tax agent committee. So where there is a recommendation from the same committee to withdraw such a license already issued, then the commissioner will not have no otherwise but to withdraw or cancel such a tax agent's practicing license. So all those are possible circumstances under which the commissioner may cancel the license of a tax agent. Good. That is question 2B, and that is the end of question 2. So that is the end of the paper. It was quite a detailed paper with a lot of deep questions, both theory and computation. That reminds you to take your time, be sure you can go through each topic keenly so that you get every single detail of each concept. If you look at the paper keenly, number one, you realize that there were 2 questions touching on taxation, advanced aspects of taxation of business income. One, we have question 2, which is about taxation of companies, advanced aspects of taxation of companies. Then we had question 4, which is about taxation of insurance companies. So in a typical advanced taxation paper, you expect that. The only thing is you may not know which part will be tested when. So be keen to do that topic keenly and be able to answer such questions. It is a must you'll have 2 or more questions on the topic of advanced aspects of taxation of business income. Another very common computation today is VAT. So make sure you understand VAT, both the theory and mathematical part. You remember we had a good question on VAT computation. It was majorly testing the concept of tax point in VAT computation. So we had both a theory and a computation question. Take your time to do that. Question 5 was a question testing a bit of theory and a computation on preparation of capital statements. Almost a must in the exam. The topic of tax investigations will hardly miss in any paper. So again, take your time and go through that keenly. Then lastly, the topic had a lot of questions on taxation of cross-border activities. So almost a must in the exam again. Take your time, know the concepts in that topic, know how to compute what we call double taxation relief, that is under double taxation treaty, understand the concept of transfer pricing, tax havens, and all that. So that was the paper, and you can continue doing the questions and other relevant questions so that you get more insight into them. Have a good day.
Hello candidates and welcome to the Manifested e-learning platform. Today we will continue with the subject Advanced Financial Management. The topic is Contemporary Issues and Emerging Trends. We are going to pick one emerging issue, which is crowdfunding. Crowdfunding, which is sometimes referred to as crowdsourcing. So candidates, in today's lesson, we have two objectives. The first objective is that by the end of this lesson, you should be able to define crowdfunding. Then objective number 2, you should be in a position to outline the benefits of crowdfunding. So let's begin by defining crowdfunding. What is a meaning? What is a crowdfunding or crowdsourcing? Now, candidates, crowdfunding can be defined as a practice of funding startups or small firms or projects by raising small amounts of money from a large number of people. Raising small amounts of money from a large number of people. Crowdfunding, as the name suggests, crowd means many, all right? So crowdfunding is the practice of raising or funding startups or small firms or funding projects by raising small amounts of money from a large number of people. Do you understand? That is the meaning. And this practice of raising small amounts of money from a large number of people can be done by utilizing online social platforms such as Facebook, Twitter, LinkedIn, and other specialized blogs. In other words, candidates, it is an organized collective effort of many non-professional people who are embedded in trust to finance a venture via the internet, where a large number of people are organized collectively to raise small amounts of money through the internet for the purposes of funding a project or funding a startup or funding a small firm. Then we say that's crowdfunding. It can also be referred to as crowdsourcing. the process of obtaining needed services, needed assets, knowledge, ideas by soliciting contributions from a large number of individuals. That is crowdsourcing. That's where we get the term crowdfunding, because crowdfunding is raising of money. It's not just money that can be raised from crowds or large number of people. You can also have what we call crowdsourcing, where a crowd of people solicit, ideas are solicited, assets are solicited, and so on. Crowdsourcing. That's the meaning of crowdsourcing. Now, candidates, in the case of crowdfunding, the same process is followed. I've just explained crowdsourcing. Crowdsourcing. I've said that crowdfunding is derived from crowdsourcing, that refers to the process of obtaining needed services, assets, knowledge, or ideas by soliciting contributions from a large number of individuals, especially from the what we call online community, rather than from the traditional employees or suppliers. In the case of crowdfunding, the same process is followed in procuring funds. And the objective of crowdfunding is to finance a project or an idea, or to help what we call philanthropic organization by soliciting funds in tiny units from a mass of people, from the crowd. That's the meaning of crowdfunding. Then, candidates, we need to outline the benefits of crowdfunding. Benefits of, what are the benefits? Benefits of crowdfunding. Having defined crowdfunding, then what are the benefits? Benefits of crowdfunding. Candidates, crowdfunding allows the fundraiser to tap into a broader investor pool and provides the investor with more flexible fundraising options. So we want to highlight some of the benefits. The first benefit of crowdfunding, number one, benefits. These are benefits. Benefits. Okay? The line has to be straight. So the first benefit, candidates will explain under the point reach. Reach. Now, a crowdfunding platform expands the fundraiser's reach by giving him or her access to thousands of investors who can see, interact, fundraiser can interact with and share a particular fundraising campaign. So it gives the fundraiser a wide reach. Wide reach. Let me use the term wide. Wide reach. Because the fundraiser uses an online platform, it can reach many people across the borders and so on. Wider reach. It has wider access to thousands and millions of investors. The second benefit of crowdfunding is in relation to public relations. Public relations. And related to public relations is marketing and marketing. public relations, and marketing. Now, candidates, from the launch to its closure, the fundraiser can share and promote his campaign through social media, through email newsletters, and other online marketing channels. And as the fundraiser and other media outlets cover the progress of the fundraiser, then the fundraiser can further promote his business by steering traffic to his website and other social media platforms. So crowdfunding can help a company improve its image and also its presence in the market. That's the second benefit. The third benefit, we can discuss this third benefit in relation to validation of concept. Validation of concept. Validation of concept. How is validation of concept beneficial? Now, candidates, the presentation of the business, the presentation of the fundraiser's business to the masses, all right, provides an opportunity to the fundraiser to validate and refine his or her business proposition. And we will also find that questions and expressions of interest from potential investors can make the fundraiser re-examine his business proposition. Because when you launch your campaign to many people, millions of people, there are many people will see your campaign at different perspectives, and they'll give you feedback. They'll ask you questions. They will enable you to see things from a perspective that you are not able to see. So by responding to queries, then the fundraiser can re-examine his business proposition, can make changes and improve. There are people who will criticize, those who will make jokes, others will provide positive criticism. And the fundraiser can use that to improve his business proposition, so that he can see whether he missed out on something important which would make his investors more likely to offer money for his project. Validation of concept. The fourth benefit of crowdfunding can be explained under the point efficiency. Efficiency. Now, candidate, crowdfunding is an efficient way to organize one's business. Why? Because in crowdfunding, an entrepreneur can centralize and streamline fundraising efforts by building a single comprehensive project profile to which he can direct all potential investors, and therefore eliminating the need to approach them individually. So instead of duplicating efforts by printing documents, compiling documents in booklets, and manually updating each one when there is an update, the fundraiser can present everything online in a much more accessible format, leaving him or her with more time to run his business instead of fundraising. So crowdfunding is an efficient way of organizing one's business. So these are four benefits of fundraising. We can add presentation. Now, candidates, by creating a crowdfunding platform, a fundraiser goes through the invaluable process of examining his business from every angle. All right? Right from the history of the business, the traction of the business, the offerings. These are the products, the services offered, the addressable market, the value proposition, and many other aspects of the business, thereby summarizing his business into a polished, attractive, and easily understandable proposition. Because you cannot do crowdfunding without going through the processes that I've mentioned. So that is one benefit that can accrue to a business or to an entrepreneur who decides to do crowdfunding. And with that, candidates, we effectively bring this lesson to a close. Remember, when I began, I mentioned that in this lesson, crowdfunding, under the topic Contemporary Issues and Emerging Trends, we had only two objectives. Number one is define crowdfunding, then explain the benefits of crowdfunding. That is the end of this lesson. That marks the end of the lesson. But before we take a break, I'll give you an assignment. Question number 1, explain the meaning of crowdfunding. Number 2, outline 7 benefits of crowdfunding. Thank you for attending this lesson and for being attentive. I hope to meet you in our next session where we continue to study more about contemporary issues and emerging trends in financial management. Bye-bye.
At this moment, we can look at a question on how to tax a sole proprietor. So here is the question. I'll read and then I'm going to show you how the tax is usually determined. This is what the question says. Lois Rubandi is a sole trader operating as Lloyd Traders. She did not maintain proper accounting records but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. We have the summary of cash transaction for the year ending that 1st December 2015. We have the receipts, balance brought down, trade receivable, cash sales, commission received, capital. We go to the side of the payments, trade payables, cash purchase, salaries and wages, rates and insurance, medical bill for self, transport, bank charges, general expenses, loan interest, new motor vehicle, drawings. Summary of assets and liability as at January 2015 and that 1st December 2015. We have as at January 2015, as at that 1st December 2015. We have furniture, written down value, motor vehicle, written down value, trade payable, inventory, trade receivable, salaries and wages, due, prepaid rates, commission received in advance, capital. Additional information. Number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. During the year, she took goods for free from the business worth 100,000 for her own use. Depreciation was ascertained as follows: motor vehicle 25% per annum on book value, furniture 12.5% per annum on book value. Bad debts written off during the year amounted to 72,000. Required taxable income for Lois Rubandi for the year 2015 and the tax payable, if any, by Lois Rubandi. So we are supposed to, number 1, required, we get the taxable income of Lois Rubandi. So we said, whenever you are told to get the taxable income, first thing that you normally ask yourself, which approach am I supposed to use whenever you are taxing a business? Is it the gross profit? Is it the net profit method? From the question, we said net profit method is used when net accounting profit or loss or income is provided. From the question, there is nothing like that. And so if it is not there, so the first thing is to check if there is net accounting profit or loss or income provided. If it is not, then it is not provided, then automatically we use the gross profit method. Gross profit method, we said, we usually start with the sales. We raise the cost of sales. We know, you can remember how we said you get cost of sales: opening stock plus purchases less closing stock minus any item that reduced the stock during the year. We get the cost of sales. Then sales minus cost of sales, we get gross profit. Then we add taxable operating income, we list them, and then we list the allowable expenses, we list them. Now, and then we compare, we take gross profit plus incomes minus allowable expenses. But we say that before you do any question on the gross profit, determine the first item that you are supposed to use, the sales. Have you been given the total sales? If not, then the first thing that you do, you have to determine the total sales. 2, have you been given the total purchases? If not, then you have to determine the total purchases so that you can prepare the statement. So in this case, we ask ourselves, have you been given the total sales? In the question, we are only given the cash sales. But just above the cashes in the summary of cash transaction, there is trade receivable, telling you that there was some evidence we sold on credit. So how much did we sell on credit? So that we add to the cash to get the total. We said if you are not given the credit sales, you have to open the debtors or receivable account to determine it. Then you add to the cash sales, then you get the total sales. 2, have you been given the total purchases? If you haven't been given, then you have to determine. In this case, have we been given? No. We are only given one part of these purchases, the cash purchase. So, but were there some evidence there were some credit purchase? Yes. Just above the cash purchase, there is the trade payable. What does that mean? We had purchase on credit. So we have to determine the credit purchase. We add the cash purchase so that we can get the total purchase so that we can use it. So this is how you go about it to determine the total sales and total purchases. We say total sales is equals to the credit sales plus cash sales. The best way to do, you see the cash sales we have been given. What we need to find is the credit sales. Now leave a space here. When you're doing it on your own, leave like 1 or 2 lines here, where now you'll be posting the figures. When you get the credit sales, where you post the cash sales, where you post, so that when you add the two, you get the total. Then for you to be able to get the credit sales, we said you open the debtors or receivables account. So you come here after the 2 lines or so, debtors or receivable account. What you do once you open that account, balance at the beginning of the period, write it there. This is the debtors at the beginning. But don't look for it, no. You are just preparing a structure to help you to get the credit sales. Then you jump. The best way is to jump like 5 lines here, 5 or 4, and then the balance at the end, as we had said when we introduced to the taxation of the business, balance carried down for the debtors, you'll post them here, debtors. You'll post them, but don't look for them. It's just a structure. Then these lines represent where we will post the totals. But now balance at the end we will post here. And then we come to the purchases. We haven't been given the total purchases. How do we get it? So we say total purchases is equals to credit purchases plus cash purchases. Now, as we have seen, we have even been given the cash purchase. So what we need to find is the credit purchase. To get the credit purchase, we open the creditors or payables account. Same case, we jump like 2 or 1 line here. Then you open the creditors or payables account. Now, for the creditors, we start with balance at the beginning of the period here. Balance brought down. That is for the creditors. There. Then jump like 4 or 5 lines, as we said with the other one, and then have the balance carried down for the creditors here. Then at the end, you'll get the total, you'll get the total. In this case, what we normally do, we go through the whole question. If we come across a cash sales, we'll post here. If we come across something that affects the debtors or receivable here, if it increase the debtors as we had said initially on this side, if it reduce the debtors on this side, then we come to the creditors. If we come across something that affects the cash purchase here, if it affect the creditors, increase the creditors, creditors being a liability, we post it on this side. Creditor, if there is any information that reduces the creditors, you put on this side, because as liability they reduce, you normally post them on this side. So let us go through the question and find out if there is any of such item. We start with the first paragraph. Don't ignore anything. We are told Lois Rubandi is a sole trader. She did not maintain proper accounting records, but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. There is no information that affects these items here, so ignore. Summary of the cash transaction for the year ending that 1st December 2015. We start with the debit. There is the receipt. On the side of the receipt, we have the balance brought down. Balance brought down at that point, it is the cash at the beginning. Cash at the beginning, we ignore. That doesn't affect. The next one is the trade receivable. So trade receivable, we have it here. And we can see it is on the receipt side, meaning we got money from the trade receivable. Trade receivables are debtor. Debtors paid. When debtors pay, it reduces the debtors. So we post it on this side. So receipt. They have paid. And they paid 1226,200. 1226,200. After that, there is cash sales. Cash sales, just below the cash sales that we have here, 5620,000. Place it there. After that, commission received. That doesn't affect. The other one is capital. Capital doesn't affect. We go to the payment side. Trade payables. If you have trade payables on the payment side, that means that they paid their payables. So meaning payables reduced. When payables reduced, you post on the debit side. So come here, payment. Payment which we have 1005 200. Then we continue cash purchase. Cash purchase, just below the cash purchase where I told you to leave some space, 1620. 800. Then after that, salaries and wages, that doesn't affect. Rates and insurance doesn't. Medical bill for self doesn't. Transport doesn't. Bank charges, no. General expenses, no. Loan interest, no. New motor vehicle, no. Drawings, no. That's the drawings of cash. Then we go to the summary of assets and liability as at January 2015 and December 2015. We have furniture's return on value, no. Motor vehicle, no. Trade payables, yes. Here we have the balance at the beginning for trade payable, 985,000. 985,000. And the other one at the end is 1180,000. So 1180,000. After that, we have the inventory, no. Trade receivables, yes. At the beginning, 781 here. 781,000. Then at the end, 821,400 here. Now that is the time that you're supposed to post when you come across the figures or the items. Then salaries and wages due, prepaid rate, no. Commission received in advance, no. That doesn't affect. Capital, no. Additional information number 1, discount allowed and discount received during the year amounted to 50,600 and 151,200 respectively. Now, discount allowed reduces the debtors. When you give debtors discount allowed, it reduces what they are supposed to pay you. So you come here, discount allowed. So discount allowed, which we have 5,600. And then we have discount received. Discount received, you receive from the creditors, people you owe money. So you'll have here discount received. Discount received, which we have 151,200. There. Then we continue. Number 2, During the year, she took goods for free from the business worth 100,000 for her own use. That does not affect any one of this. She just took goods from the business for her own use. Doesn't affect. Then number 3, depreciation was sustained as follows. Depreciation does not affect any one of this one. We go to number 4. Bad debt written off during the year amounted to 72,000. Bad debt does. So bad debt is usually from the debtors. That some people who have refused to pay and you have written them off. When you write them off, it means that it reduces what you are demanding from them. So we have it here. Bad debts written off. Bad debts written off, which you have 72,000. 72,000. Now you note that is the end of the question. Now what you do is to do the summation. Now we start with the debtors or receivable account. We want to know how much was the credit sales, which is supposed to be the balancing figure. The balancing figure. How do you do that? Take the totals on this side and write them here. We have 12, 26,200, and then we add 5,600, and then we add 72,000, and then we add 821,400, which we get 21,7,200. Then this one should be the same as on this side, 21,7,200. Then the difference between this figure and what we have posted on this side, if we had like 3, this one and the other 2, the difference is the one that we post here as the balancing figure, but we only have 1, so we minus 781,000, which gives us 1389,200. Now that we have the credit sales, we transfer here, so 1389,200, and then we now add the cash sales to get the total sales. So we add the cash sales, which is 56,20,000, and then 56,20,000, which give us 7,009,200. There. Now we come to the creditors. We want to get the credit purchase, which is supposed to be the balancing figure. We take the totals on this side, which is 1,005,200, and then we add 151,200, and then we add 1180,000, and then total, which is 23,36,400. Then we'll have the same here, 23,36,400. Then we minus the totals on this side. On this, we only have 1 for now. If we had 2 figures, the 3, we could have minus them. So 90,85,000, which gives us 13,51,400. There. We have the credit purchase. Now we can transfer the credit purchase here, 13,51,400, add the cash purchase. So we add cash purchase of 16,20,800. 16,20,800, which give us 29,72,200. There. Now we have our total purchases and our total sales. From there, we can prepare the statement. So we come here, the name of the business, it is the Lloyd Traders. So you come here, Lloyd Traders, sole proprietor, taxable income, for the year ended 31st December 2015, so we'll have a column where we'll be posting the figures. And as we had said about the gross profit method, we start with sales, of which case now sales is the one that we have determined here, 7,009,200, and then we less cost of sales. For the cost of sales, we start with opening stock. Opening stock is in the summary of the assets and liabilities. Inventory at the beginning, 1241,600 plus the purchases. The purchases is the one that we determined here, the 2972. 200. We minus the closing stock. Closing stock, which we have 14,600. And then remember to minus any item that reduced the stock during the year. And we say items that reduce the stock during the year are like damaged, stolen, withdrawn stock. For this question, we only had one place. Number 2. During the year, she took goods for free for the business worth 100 for her own use. And they are goods. They must be goods, not cash or when silent. When silent, just ignore. Because in that case, you cannot assume they are goods. Only when they are goods or inventory that they do or we do come and deduct them here. So she withdrew 100,000. Now, having no other, we close the bracket and get the total. The total, that is the net, 1241,600, and then we add 2972, 200, 2972, 200, and then we minus 1480, 600, and then we minus 100, which we get 33,200. And that will give us the gross profit. So gross profit, which would be, we take 7,900, and then we minus that figure, which give us 43,76,000. After that, we usually add other taxable operating incomes. Now, the best way to do it, instead now for you to go and look for the taxable operating income which you list here. Remember, we had looked at the topic on the on an area on taxation of operating income or taxable operating income. Now, instead of looking for them, it will be a waste of time. The best way is leave a space of like 3 or 4 lines here, and then now less. Remember, in the statement when you're using the gross profit, we said once you add the taxable operating income, you less allowable expenses. So you have left 3 or 4 lines, and then now you have less allowable expense. I want to underline because these are headings of the figures that we'll be posting, or the items that we'll be posting, of the taxable operating income here and allowable expenses here. We need to go through the question, look for a taxable operating income which will be posting here, allowable expense here. We start from the summary of cash transaction because up there in the first paragraph there's nothing. The first under receipts balance brew down. We say that's the cash at the beginning of the period. We ignore. It is not an income. It's just a cash we had when we were starting the period. Trade receivable, that we used it to get our debtors here, our sales here. The other one is cash sales. It was used to get the sales. Commission received. Commission is an operating income, not an investment, and it is a taxable operating income. Now, having gotten the commission, what you do is this. Check around if there is any other place that commission has been mentioned. If you go to the summary of assets and liability, there is another commission received in advance. So what do? When you have it, somewhere else it has been mentioned, have commission income here. Then open a bracket. Of the information given, if something increases the item like commission add, it reduces the commission less. Like now, and also, if the commission is relating to this year, you add. If it is relating to another year, you minus. That's simple logic. Anything for this year, you add. Anything for another year, you minus. Like if we start with the commission received, you see it is that in the transaction for this year, commission received in the year, it is for this year. So we add. We add 124,000. Then, in the summary of assets and liability, commission received in advance, and we have at the beginning and at the end. Now, if you receive commission in advance when you are starting the year, ask yourself, you are receiving it in advance for which year? Don't look at when it was received. Look at it is relating to which year. When you receive it in advance at the beginning, it is for this year. The year we are taxing, like in this case, it is the year 2015. Received in advance in January, it is for the current year. Yes, it was received last year, yeah, because it was received in advance by the beginning. It must have been received last year, but it is for the current year. Anything for this year, we add. That's what we have said. So we have 80,000. Then, commission received in advance at the end of the year. When you receive commission at the end in December, it must have been for the following year. So not this year, for the other year. So in that case, we minus 136. So we need to compute the net. So we say plus 124,000 and then plus 80 and then minus 136, which give us 68,000. 68,000. Then we go back to where we found that commission. We found it in the summary of cash transaction for the year. Then continue from there. Don't jump anything. Consider everything provided. After commission, there is capital. Capital, yes, it is not even an income because capital, it is what the owner introduced into the business to assist him to run the business, So that's not an income and it's not even an expense. We go to the payment side. Trade payables, we used that to get the purchases. Cash purchase, we used it here. Salaries and wages, that is an expense. And salaries and wages, we said is a allowable expense. Unless it relates to the owner, it is allowable. So we'll have here salaries and wages. But as we said, before you post it, check if it is mentioned somewhere else. It is mentioned in the summary of assets and liability. Almost in the middle, there is salaries and wages due. Higher, we have to adjust it the way we said. We start with the one that was paid in this year. If it was paid in this year, it must be for this year. We add 1660, 400. Then we go to the summary of assets and liability. Salaries and wages due at the beginning. Due at the beginning, it must have been for last year because it is what the arrears that were supposed to be paid last year, but they were not paid. So which year are they relating to? It is last year. Yes, they will be paid this year. Actually, they are in this 1660, because it's arrears for last year. They must have been paid here, but they are not relating to this year. The workers offered the service last year, only that they were not paid. So since it is not for this year, minus, and we minus the 184,000. And then we have have salaries and wages due at the end of the current year. At the end of the current year, that is for this year now, because it is workers offered the service this year, only that we didn't have money to pay them by the end of the year, but they rendered the service this year. So the income was generated, the one they assisted to generate was for this year. That one we add. We add 150,000. Now, because there's nowhere else we have salary being mentioned, we can get the net. So 1660, 400, and then we minus 184,000, and then now we add 150,000. So in this case we get 1626, 400, which we minus. And it's also important for me to mention that this one we normally do it this way, instead of opening the salaries and wages account or even the commission account where you try to get for commission for this year, the one that you bring here, or this, it will give you the same, but that's a long process. It's a wastage of time. Just do it this way. Then we go back to where we found the salary. After the salaries and wages, there is rates and insurance in the cash transaction. Rates and insurance, that's allowable because they are for the business. They are allowable expenses. So we'll come here, rates and insurance. Now we check if it is mentioned somewhere else, that rates and insurance. Yes. If you go to the summary of assets and liability, there is prepaid rates, that last item. So we have to open a bracket there, and we start with the rates and insurance in that year. The one that was paid, it is for that year. We add, and we add 320,800. Now when you come to the prepaid at the beginning, you see when you are starting the year January and you have a prepayment, that must have been for the current year. You are prepaying for the current year. That we add 50,000. And when now you get to the end of the year and you have a prepayment, you are prepaying for the following year, which means whatever you paid this year, part of it was for next year. That one you minus. So we minus 72,000. Having no other place it has been mentioned, we get the net, which would be 320,800, and then we add 50,000, and then we minus 72,000, which give us 298,800. There. We go back to where we found that rate and insurance in the cash summary. After rates and insurance, medical bill. Medical bill is allowable, but the problem this time is for self. And we said here, when you are taxing a sole proprietor, any expense relating to the owner, private expense, we don't allow. This we even said when you are looking at the general allowable and non-allowable expense. And a non-allowable, anything to the owner, we don't allow. Private expenses, so that is not allowable, we won't deduct. The other one is transport. Transport is allowable and it isn't mentioned anywhere else. So transport, which you have 56,400. After transport, bank charges. Bank charges are also allowable. They are for business and they are not mentioned anywhere else. Bank charges, which we have 3,000. After that, general expenses. General expenses are also allowable. There are small expenses that are put together for the business. General expenses. General expenses, which you have 145,400. The next one is loan interest. Loan interest, we said interest on money borrowed and invested in business is allowable. So loan interest, allowable. Amount, 120,000. After that, new motor vehicle. Fixed asset, we said we don't allow. We allow capital allowance. of which case we said motor vehicle capital allowance at the rate of 25%. Capital allowance, written in short as CA, motor vehicle, 25%. But check whether you have the balance at the beginning. We take the balance at the beginning. If you go to the summary of assets and liability, at the beginning we had a motor vehicle, 960, of which case will be 960. Then add the one that was purchased in that year, which was 600,000. With nothing more, get the amount. That will be 960,000 plus 600,000, giving us 1560,000 times 25%, which give us 390,000. We go back and continue. After the new motor vehicle, drawings we said they are private expense, they are for private use, we don't allow them. Then we go to the summary of assets and liability. Furniture is a fixed asset, we claim capital allowance on it, so we'll have capital allowance on furniture and fitting, in short. So 10% of, we start the balance at the beginning 120, and there was no addition of furniture. There is nowhere we are told about addition, so we just take 10% of 120, which gives us 12,000. After that we go back, summary of assets and liability for furniture. We have considered motor vehicle, we had considered already, is there, capital allowance. Trade payables, that's not an income, not an expense. Inventory, not an income, not an expense. Trade receivable, not an income, not an expense. Salaries and wages, we had considered. Prepaid rates, we had considered. Commission received in advance, we had considered because we had met them earlier. Capital, no, that's not an income or an expense. Additional information, number 1, discount allowed and discount received during the year were 50,600 and 151,200. Discount allowed is an expense and an allowable one. We'll have discount allowed, which we have 50,600. Then discount received 151,200. That is an income and a taxable one. We had said that when we were looking at the general taxable and non-taxable income. Discount received, a taxable operating income, 151,200. Then additional information number 2. During the year she took goods for free from the business worth 100,000 for her own use. That's an expense, yes, but it's not usually allowable, we said, because it's for private use. Number 3, depreciation was ascertained as follows. Remember, we said depreciation is not allowable. What we allow are the capital allowance in taxation, which we have considered. So ignore. Depreciation is not allowed. Number 4, bad debts written off during the year amounted to 72,000. Trade bad debt written off are allowable. Unless we are told they are not relating to the trade, to the business, they are allowable. Bad debt. And take note, don't confuse with provision. Provision are the one that we say specific provision we allow, general provision we don't. Bad debt are bad debt, and they are allowable as long as they are relating to the business. Bad debt written off, which we have 72,000. Bad debt is the last item provided. So what do you do now? We are done. We now have to get, we come now to the end here, we get net taxable operating income. So from operation, how much is the total taxable income? That means that we take the gross profit plus this income minus the expenses, allowable expenses. We start with 4376,000. Then we add 68,000. And then we add 151,200. And then we minus 1626,400. And then we minus 298,800, and then we minus 56,400, we minus 3,000, we minus 145,400, we minus 120,000, we minus that 390,000, we minus 12,000, we minus 5,600, then we minus 72,000. It gives us 18,260. So what we do is this. This being a sole proprietorship business, we had said earlier on, we tax the sole proprietor on his or her own income. So once you get the net taxable operating, add taxable investment income. So you add taxable investment income. If operating income is positive like this one, if the operating income is negative, you carry it forward to next year to be deducted against the profit of next year. Remember we said we carry forward a loss up to a maximum of 10 years. Now, if you look at the question that we have, there is nowhere we are told about investment income for now. But if you had non-qualifying dividend, remember those are dividends which withholding tax is not final. Non-qualifying interest which withholding tax is not final. Royalty income for resident withholding tax is not final. Rental income for commercial buildings, for residential above 15 million per year, we should add them here. But for this question we don't have, so we would have a dash. And so meaning we can now get total taxable income, which would be the same because the investment is 0, 18,600. And required number 1 ends there. Now we have the taxable income. What we had said, the first thing is to determine the taxable income. The second one now is to determine the tax payable. Criteria of determining the tax payable. Now we have to tax that income on that individual, and which we said that sole proprietor do not have separate legal entity from the business. So the income of the business is taxed on the owner. So how do we tax? We had said at graduated scale rates in the same way as employment income. So we want to look at how we tax that income. We are going to use the scale rate that was used in the year 2022. But the concept is the same. What happened is that if the rule changes, and the reason why we are looking at year 2022 because we are looking at the exam of December 2023, if the rule change, you find that the table just changed, but the concept of getting what you are, the computation is or remain the same. So I'm going to delete this part here so that we can see how we can tax the 18,260 to get the tax that is payable by this sole trader. So to come here, tax payable. So we want to get the tax payable. So if you look at the income that we have, it is 18,260. Now there is a table that is given by the examiner in an exam, or the question, as long as you are doing the question about tax, you will be given first page. And as we have said, we are using the table that was used in the year 2022, but it is relating to the year of income of 2021. But that's the one that we are going to use. So if you look at the top there, there's somewhere with the rates of tax, including wife employment income, self-employment income, and professional income rates of tax. Year of income 2021. Assume that the following rates of tax were applied throughout the year of 2021. We have the monthly taxable pay, annual taxable pay, rates of tax. Because we are taxing an year income, not 1 month, it was for the year ending 2015, 1 year, we use the annual taxable pay, which starts between 1 shilling to 288,000. The percentage is 10%. Between 288,001 to 388,000, 25%. Excess over 388,000, 30%. So if you look at the income that we have there, 18,600, that means that we go to the excess of 388. So we have to tax up to the rate of 30%. How do you start? You start with the first. Now, at the rate of 10%, pick the last amount appearing in that range. Between 1 shilling to 288, pick 288. So the last amount appearing there. So we say first 288,000 times 10%. It gives you shillings here 28,800. Then you come to the next. The next, you take between 288,001 to 388, 25%. Now we don't pick the last amount and we tax at 25 like we have done for the first one. No. You take the difference between the last amount appearing there, which is 388,000, minus the last amount appearing in the previous rate. In the previous rate, the last amount is 288,000. So 388,000 minus 288,000 give you 100,000. So to come here, 100,000 times 25%, which gives you 25,000. 25,000. After that, we go to the excess over 388,000, which we tax at the rate of 30%. Excess over 388 means what? It means that we have already taxed 388. If you take 288 plus 100, that will be 388. So whatever is above 388, you tax at the rate of 30%. How much is that? So this we call it last. The last, which is now the total taxable amount, 18,600. You less what you have taxed. You have taxed 388. 288 plus 100, that will be 388. So this one, you multiply by 30%. The excess now. So let us get the excess first, which would be 18,600 minus 388,000 gives you 14,32,600. Then times 30%, which gives you 429,780. Then, because that is the last one, you add those taxes to get something called gross tax. Gross tax, which would be the 429,780 plus 25,000 plus 28,800, which gives you 483,580. That we call it gross tax. Now, after you get the gross tax, there are 3 items you are supposed to deduct here, which are called set off. They are the same that we talked about when we were looking at the employment income, only that we don't have pay as you earn. Pay as you earn is usually for a person who is on salary. This is just a person in business is not on salary, so we ignore. But now, personal relief is one of the set-off we talked about, of which case personal relief is provided in the table. If you look at the table we have used to tax, just after the table there is personal relief per month 2,400. If you multiply by 12, you get per annum 28,800. The next one is called insurance relief, and we said this for a person who have education or life insurance cover or NHIF insurance cover, and I showed you how to compute. So if this individual had that, if this sole trader, that is a lorry trader, had the insurance life or education on NHIF, we could have claimed the insurance relief, but didn't have, she didn't have, so we ignore. The other one is withholding tax on investment income, which withholding tax is not final. That means that you have to look at the investment income you have added here. If you had added something like non-qualifying dividend, remember there is a withholding tax of 15%. You'll come and say investment income, withholding tax 15% of the gross to remove it. But we didn't have. So for now, the only set-off we have is the 28,800, and this will give us the net tax payable. The net tax payable, which will be the 483,580 you minus the 28,800, which gives us 454,780. And that answers required number 2, where we were supposed to get the tax payable by Royce Lubandi, and it ends there. For now, that is how we usually tax the sole proprietorship business. We end our lesson there until next time, when we are going to look at the taxation of the partnership. Thank you very much. Yours here, Patrick Kamau Kamure.
Greetings and welcome to the lesson. We are going to answer question 1. This is a question that is in 2 parts, A and B. And part A reads, CMP Limited is a production company that employs 50 workers. The company has the following payroll procedures. 1. The factory foreman interviews applicants, and on the basis of the interview, either hires or rejects them. When applicants are hired, they fill in an employee's withholding exemption certificate and forward it to the foreman. The foreman indicates the hourly rate of pay for the new employee in the W4 form, and then forwards it to a payroll clerk as notice that the worker has been employed. The foreman verbally advises the payroll departments of any adjustments to the hourly rate of pay. Number 2, a supply of black time cards is kept in a box near the entrance to the factory. Each worker takes a time card on Monday morning, fills in his name and notes in pencil their daily arrival and departure times. At the end of the week, the workers drop the time cards in a box near the factory door. Number 3, each Monday morning, the completed time cards are taken from the box by a payroll clerk. One of the payroll clerks then records the payroll transactions using a computer system which captures all information for the payroll journal as calculated by the clerk and automatically updates the employees' earnings records and general ledger. Employees are automatically removed from the payroll when they fail to return in a time card. 4. The payroll checks are manually signed by the chief accountant and given to the foreman. The foreman distributes the checks to the employees and arranges for the delivery of the checks to those who are absent. The payroll bank account is reconciled by the chief accountant, who also prepares the various payroll tax reports. Required: discuss 6 deficiencies in CMP Limited's internal controls with the associated risks for each deficiency. So that is the question. There are 4 procedures. We are required to discuss 6 deficiencies in CMP Limited's internal controls with the associated risk for each deficiency. Can I hear from you, members? There is lack of segregation of duties. That is true. This question was borrowed from August. This is August 2023. August 2023. Question 1. A. Deficiencies and associated risks. So you can see the question is allocated 12 marks. So candidates were required to give deficiencies and risks. So Roman 1, you have to give first of all one deficiency, then you give the associated risk to earn 2 marks per point. So like in point 1, you should indicate the deficiency. Like Sue here says, lack of segregation of duties. That is a weakness or deficiency. So what is the associated risk of lack of segregation? This is segregation of duties. Because you've seen the foreman candidates here, the factory foreman interviews applicants on the basis of the interview, either hires or rejects them. When applicants are hired, they fill in an employees withholding exemption certificate W4 form and then forwards it to the foreman. So you see the foreman is interviewing. When they fill in the form, they submit the form to the foreman. And you can see the foreman again indicates the hourly rate of pay for the new employees. He's hiring them. They are giving him the forms. He's determining the hourly pay. Do you see that? Then the foreman again verbally advises the payroll department of any adjustments to the hourly rate of pay. So the foreman has too much control over the hiring process, including approving hourly hours and distributing the checks. You saw in note number 4, the payroll checks are manually signed by the chief accountant and given to the foreman. So that is a weakness. There is lack of segregation of duties. But what is the risk that is associated with lack of segregation of duties in the case of CMP Limited? Too much control over these activities, candidates, increases the risk of unauthorized hiring. The foreman can decide to hire employees without any authorization from the company. Do you see that? There could also be risk of errors in hourly hours or pay rates. There could be risk of errors because you see is only one person doing many tasks. When you have segregation of duties, a worker can check the work of another one and identify any errors. There is a risk of potential theft of payroll fraud. So there are many risks associated with the lack of segregation of duties in relation to this company. Candidates are just to give a deficiency and the risk to earn the 2 marks. Now give me the second deficiency. There are many risks, and deficiencies, candidates. If you are to read, almost every sentence is a deficiency here. In note number 2, we read that a supply of blank time cards is kept in a box near the entrance to the factory. Each worker takes a time card on Monday morning, fills in his name and notes in pencil, their daily arrival and departure. That is a deficiency. There is weak control over timekeeping. Weak control over timekeeping, because the workers are self-recording their time, which can lead to inaccuracies and potential fraud. If you tell workers to just fill in the time they came in without any controls, then you can be sure there will be inaccuracies. Weak control over timekeeping. That is a deficiency. Employees self-record their time. Employees self-record their time. That is a weakness. And we see they are even recording in pencil. That tells you that the pencil tells you that it's very easy to tamper with the record. You can rub off what has been written in pencil very easily. You see that? That is a weakness. Weak control over timekeeping. Deficiency is that employees self-record their time, which can lead to inaccuracies and potential fraud. Risk. What is the risk of weak control over timekeeping? What is the risk of employees self-recording their time? Here, candidates, there is a risk of errors in calculating errors. Risk calculating hours. Risk of errors in calculating work hours. There's that risk that there will be errors because employees are recording their time without any control, without any check. No one is counter checking, because ideally you would have someone else recording their time if there is no automated system where employees can check in and their data is captured electronically. You see that? Which could lead to incorrect pay. Which could lead to incorrect pay. Because payment is made on the basis of hours. So if the hours are inaccurate, then the pay will also be incorrect. That is the risk. Which could also lead to overpayments. Okay, let me write that. And potential overpayments. That is the second deficiency and associated risk. We are identifying candidates' risks. Discuss 6 deficiencies. Have you come across any other? Incomplete or lack of documentation. I'm summarizing from what she has said. Incomplete documentation. That is a deficiency. So what is the risk of incomplete documentation? Risk of increase. And make sure you write candidates' risk so that it's clear. Because the question is deficiencies and associated risks. So when you are giving a deficiency, then you need to indicate that below is the risk. So you have to show the deficiency and the risk. The deficiency and the risk. The deficiency and there is, what is the risk of having incomplete documentation? There is increased risk in errors. Increased risk of errors. Just as she says that the risk here is just errors and unauthorized changes, or even deliberate manipulation of pay rate. There is that risk of deliberate manipulation of pay rates. That's another risk. Deliberate manipulation of pay rates, because there is no proper documentation. An employee can say, this is what I had, but in the back of the motive is to deliberately manipulate the pay rate, because there is that deficiency of incomplete documentation and even authorization. So Sue, before Sue, I can see Hilary says risk, insufficient and inappropriate evidence about the adjustment. So then says possibility of ghost workers, misutilization of funds to pay workers. Is that a risk, Sue, or is it a deficiency? When you say possibility of ghost workers, we are on the fourth deficiency. So possibility of ghost workers, is that a weakness, or is it the effect of a weakness? Because it sounds like a risk. When you say misutilization of funds, that is a risk. I don't think it is a deficiency. It looks like an effect. Now, candidates, when you are talking of internal control system, always remember the control on review. You see, the work of these employees is not reviewed. No one reviews the work of another. There is no approval of even the payroll. So when you are given a question like this one, there are those controls that you all know, which should be in your mind. So you should be referring to what is in your mind with what is happening in a company like this one. You can see we have here a production company that employs 50 workers. So we're given the payroll procedures. We all know the controls that are required to be in place over any payroll. So one of the controls should be in relation to review and approval of the payroll. Does that happen in this company? No. So that is a weakness. Inadequate review and approval. There is inadequate review and approval of the payroll. Nowhere do we read that there is an employee who approves. We read in note number 4 that the payroll checks are manually signed by the chief accountant and given back to the foreman. Then the foreman distributes the checks. There is no where we read that these procedures are reviewed by any other officer of the company. There is no independent review and approval of the payroll. There is no independent review of the calculations. There is no independent review of the journal entries. So what is the risk that is associated with inadequate review and approval of the payroll? And to answer that question, you can first ask yourself a question: why do we monitor? We monitor, we review so that we can identify if there are errors, if there is any fraud, if there is any unauthorized payments. So the reason why this company needs another officer to review the work of the foreman and the accountant is to identify errors or fraud or even unauthorized payments. So the risk here is a risk of errors, fraud, and unauthorized payments. Errors, fraud, and unauthorized payments. There's the risk of errors. If there is no review, there is no monitoring. If there is no independent review, then there is increased risk of errors, fraud, and unauthorized payments. It's that simple. That is number 4. Give me number 5. The fourth weakness. We read in the last part of this question that the payroll checks are manually signed by the chief accountant and given to the foreman. The foreman distributes the checks to the employees. The foreman distributes the payroll checks to the employees, including arranging delivery to absent employees. That is a deficiency. The foreman, that's what is responsible for distributing payroll checks. Foreman is responsible for distributing payroll checks. What is the risk associated with that deficiency? He even arranges for delivery to absent employees. What is the risk? Don't you see candidates that can allow the foreman to withhold or misappropriate checks, which may lead to disputes with the employees? The risk is misappropriation of checks by the foreman. There's that risk, misappropriation of checks, because he is handling the checks, he is distributing the checks, he is even withholding checks for employees who are absent. The foreman distributes the checks to the employees and arranges for the delivery of the checks to those who are absent. That increases the risk of misappropriating the checks, potentially leading to disputes with employees or even payroll fraud. There is the risk of payroll fraud. That is the deficiency and risk number 5. You understand, candidates? Now you notice from what we've read, candidates, there is no mention of strong access controls for the payroll system. Because here we have given information, the company has the following payroll procedures: a strong internal control system over the payroll must have strong access controls for the payroll system, such as passwords, protection, user restrictions, and so on. It's not part of these procedures. The company has the following payroll procedures. There is no mention of strong access controls. Lack of strong access controls, and these are controls to the payroll system. What is the potential risk associated with this lack of access controls? The risk is simple, candidates: unauthorized access to the payroll data. Unauthorized access to the payroll data. Because there is no mention of strong access controls, and there is a risk of unauthorized access to the payroll data, and even potential manipulation. And potential manipulation. Anyone can manipulate the payroll data. Is that risk because there are no strong access controls. That's it. These are 6 deficiencies and 6 risks. So let's move on to the part B of the question. You are the auditor of Flower Mint Limited, a company engaged in growing and exporting flowers. Assume that when you arrived at your client's office on 11th January 2023 to begin the audit for the year ended 31st December 2022, you discover that the client had been drawing checks as creditors' invoices became due, but not necessarily mailing them. Drawing checks as the invoices became due, but not necessarily mailing them. That means that the checks are written by the company in favor of creditors, but they are not mailed to the creditors. Because of working capital shortage, some checks may have been held for 2 or 3 weeks because of working capital shortage. So the company didn't have enough working capital. So instead of paying the creditors money, they withheld that money so that they can meet their short-term needs for 2 or 3 weeks. Please understand that as we move on. The second paragraph is that the client informs you that mail checks amounting to 27.6 million were on hand as at 31st December 2022. He says that these December 2022 dated checks had been entered in the cash disbursements book and charged to the respective creditors' accounts in December because the checks were pre-numbered. Heavy sales collections permitted him to mail to the checks before your arrival. The client wishes to adjust the cash balance and accounts payable as at 1st December 2022 by 27.6 million because the cash account had a credit balance. The client is also reluctant to reflect an overdraft in the financial statements. This always happens, candidates, in practice, is it not so? Required, Roman 1, prepare a detailed audit program indicating the procedures you would use to satisfy yourself of the accuracy of the cash at bank balances on the client's financial statements. Roman 2, Discuss the propriety or otherwise of reversing the indicated amount of outstanding checks as at 31st December 2022. So you can see with a question like this one, you have to read very fast and answer the questions, because you see they are just 5 marks and 3 marks. So let's look at it again. You are the auditor of Flour Mint Limited, a company engaged in growing and exporting flowers. Assume that when you arrived at your client's office on 11th January 2023. So you arrived, the auditor arrived. Let's analyze the question. Arrival of auditor. We are given the date. Assume that when you arrived at your client's office, you are the auditor. This is 11th January 2023. To begin the audit for the year ended 31st December 2020. So, year end is December 2022. So you arrived in 2023 January to audit the December 2023 records. And you discover that the client had been drawing checks as the creditor's invoices became due, but not necessarily mailing them. So the records show that the auditors have been paid, but in reality they have not been paid. On paper they are paid, but they have not received the money. So the company has a working capital shortage. And what does the client tell you as an auditor? The client informs you that unmailed checks amounting to 27.6 million were on hand as at 31st December 2022. So at this date, the end of this accounting period, we have 27.6 million shillings worth of checks. So the checks have been drawn. They are still within the company, but the creditors' accounts have been debited. They were on hand. So he says that these December 2022 dated checks had been entered in the cash disbursement book and charged to the respective creditors. So the creditors were paid. The creditors were paid. The creditors were paid. Balance, then pay your debit. That means that the balance sheet does not have these creditors. Is that not the effect? Had been entered in the cash disbursement because the checks were pre-numbered. Heavy sales collections permitted him to mail the checks before your arrival. Do you see that? So before you arrived here, you can see the date is 11th, just before 11th. In 2023, it tells you that the checks were disbursed. Do you see that? Then in the third paragraph, read that the client needs to adjust the cash balance and payable and accounts payable as at 31st December 2022 by 27.6 million because the cash account had a credit balance. The credit account had the cash account had a credit balance. That is abnormal. It is abnormal because in practice there is no way you can have a credit balance on the cash account. The client is also reluctant to reflect an overdraft in the financial statements. Have you understood the problem? us. Have you understood the problem? First of all, understand the problem. Where is Hilary Sue? Isha? Isha, have you understood the problem? Have you understood the problem? Say how to understand the problem. Aisha says yes. We always say a problem well defined is a problem half solved. So prepare a detailed audit program, and these are just 5 marks. Indicate the audit procedures you would use to satisfy yourself of the accuracy of the cash at bank balance audit program. These are just procedures. Audit procedures. Audit program to satisfy yourself. Now, to satisfy ourselves or yourself of the cash at bank balance, the auditor ought to perform certain procedures. One is confirmation of bank balances. Confirmation of bank balances. You have to do a confirmation of bank balances. You have to obtain bank confirmation letters directly from the client's banks, then verify the accuracy of the bank reconciliation at the end year, because the company is required to have done a bank reconciliation at the end of the year. So you need to check if the company reconciled the cash at bank balance with the cash within the business, because the bank statement shows the transactions that were carried out at the bank. The cash book also has a bank column. So the auditor has to obtain, first of all, confirmation letter directly from the bank, then use that confirmation letter to verify, to do a verification, to verify the accuracy of the bank reconciliation as at the end of the year. The auditor, in other words, or furthermore, has to reconcile the bank statements to the general ledger. That is a procedure. So because here candidates, we are talking about bank balances, you can only assure yourself, you can only satisfy yourself of the accuracy of the amounts shown in the books of this company by seeking confirmation directly from third party. The bank here is a third party. The second procedure is to review the bank reconciliations. The company must have bank reconciliation. So the auditor should verify the accuracy of the outstanding checks, because when you do a reconciliation, you can know the outstanding checks, the unpaid checks. Okay, what is the amount of the outstanding checks that then inspect a sample of the checks that have not been honored or the ones that have been cancelled, to ensure proper authorization and endorsements. In carrying out or reviewing the bank reconciliation, the auditor may also review bank charges and interest income for accuracy and appropriateness. 3, examination of cash transactions. That is a procedure that can be done by the auditor to examine cash transactions. The auditor can test a sample of cash receipts and disbursements for proper authorization, recording and posting to the general ledger. Then verify the cutoff of cash transactions at the year end. You understand? Examination of the cash transactions may also involve reviewing bank transfers and electronic fund transfers for accuracy and completeness. Review bank accounts. The auditor may also just choose to review the company's bank accounts. Identify all bank accounts. Alright, first of all, you identify all the bank accounts maintained by the client. Then ensure that all bank accounts are properly reconciled. All bank accounts, in reviewing the accounts, should be reconciled. The auditor has to confirm that all the bank accounts have been reconciled. Evaluate internal controls is yet another audit procedure or program. Evaluate internal controls. Assess the adequacy of internal controls over cash receipts and disbursements. And then evaluate the segregation of duties and access controls for cash transactions. The auditor may also review the procedures for reconciling bank accounts and resolving discrepancies. Consider unused transactions. The auditor should consider unusual transactions by investigating any unusual or large transactions, such as large withdrawals or large deposits. You understand? So there are many audit programs, and this was just to give 5. Perform analytical procedure. Compare the current cash what with the prior periods. That is a good point. Perform analytical procedures and then compare the current cash and bank balance with prior periods. Any other point? Any other point? There is the cutoff procedures also. The auditor can also assess cutoff procedures. And just to support what Aisha has said, the auditor can confirm that checks dated in December 2022 were recorded in the correct accounting period. That is what we are referring to as cutoff. All right. Assess cut-off procedures. The checks for December 2022 should be related to December 2022. They should not be recorded in January 2023. Assess cut-off procedures. Then verify that subsequent payments to creditors are not double recorded in January 2023. Verify that subsequent payments to editors are not double recorded in January 2023. So if you are carrying on procedures, anything related to bank or to bank, then don't forget confirmation with the bank. Don't forget bank reconciliation, because these are controls. Now that is Roman 1. Roman 2, discuss the propriety or otherwise of reversing the indicated amount of outstanding checks as at 31st December 2022. That's what we read in the third paragraph. The client wishes to adjust the cash balance and accounts payable as at 31st December 2022 by 27.6 million. The client, let me read, informs you that unmailed checks amounting to 7.6 million were on hand as 31st December 2020. They were unpaid 31st December 2022. He said that this December 2022 dated checks had been entered in the cash disbursements book and charged to the respective creditors in December because the checks were pre-numbered. You see that? When you go back a bit, we read that you discovered that the client had been drawing checks as the creditors' invoices became due, but not necessarily mailing them. So the checks had been drawn, but they had not been mailed. That means that the cash at the bank ought to have reduced by 27.6 million, but it has not reduced because that money has not been withdrawn by the creditors. So the company would wish to reverse that. So you are to advise on the propriety or otherwise of reversing the indicated amount of outstanding checks as at 31st December 2022. What do you think? It's not appropriate. You've said reversing the checks is not appropriate. Can you give us the justification? So reversing the checks would misstate the financial position. The reason is reversing the checks would give a misleading, okay? It will be misleading, will misstate the financial position. Let me use the word misstate, would misstate the financial position of the company. It would understate accounts payable. It would understate accounts payable and overstate the cash balance. That also violates accounting principles. It violates accounting principles. How does it violate accounting principles? It would not accurately reflect the economic substance of the transactions. The economic substance of the transaction will not be stated. And that would potentially mislead users. That would mislead users of the financial statements. Reversing the checks would mislead users of the financial statements. It would provide a misleading picture of the company's financial health. So that is how you earn the 3 marks. Now, if you are to be asked the right approach, what would be the right approach? What should the company do? Disclose, candidates. The company should just disclose. What should be disclosed here? Disclose the outstanding checks. The company should disclose the accounting checks. should disclose the existence of the outstanding checks in the notes to the financial statements, or even just classify the checks as current liability. They should be classified as current liability. The checks should be classified as accounts payable or just current liability. Then follow up to ensure that the checks have been cleared by the bank, or the checks were issued before the auditor arrived. Do you see that? So that's it for this question. Any question? Do you have any question? So thank you for attending the lesson. Hope to meet you in our next session. Bye bye. Welcome to the lesson. Today we are going to answer August 2024 question 1. We already did question 1A and B. We're going to answer question C. Mavuno Bora Limited is an agro-based company incorporated in Kenya. The company intends to invest in a capital project which will be based in Cape Town, South Africa. Additional information number 1. The project will commence on 1st January 2025 with the initial capital of 5 million South African rands, which will be used in acquiring agricultural machinery with an estimated useful life of 5 years with zero salvage value. The straight line method of depreciation will be applied. Number 2, to enable the farm pay land rates and other working capital requirements, an additional 2.5 million rands will be required, and it is expected that this amount will be recouped in full at the end of the project's useful life. Number 3, annual sales revenue from the project are estimated as follows. We have the sales from the year 2025 to 2029 in rands. The number 4, variable operating costs are expected to be 20% of the sales and are assumed to accrue evenly. Number 5, the exchange rates between the Kenya shilling and the South African rand are as follows. We are given the exchange rates from the 1st of January 2025 to the 31st of December 2029. Number 6, all the cash flows are expected to occur at the end of the year. Number 7, the cost of capital for both South Africa and Kenya is assumed to be 12% per annum. Number 8, assume that the corporation tax rate in South Africa is 30% and no further taxation will be levied in Kenya. Required, the net present value of the project in Kenya shillings, 8 marks. Roman 2, based on your results in C1 above, advise the management of Mavuno Bora Limited on appropriate course of action. Net present value, we know candidates, is equal to the present value of cash inflows minus the present value of cash outflows. That is how to calculate the present value. So what is the cash outflow? The cash outflow, the project will commence on 1st January with initial capital of 5 million rands. 5 million rands. What is the cash outflow for this project? The net present value is equal to the present value of cash inflows. This is we have to calculate first of all the NPV, We know NPV is equal to present value of cash inflows minus present value of cash outflows. That is the formula. And we read in note number 6 that all the cash flows are expected to occur at the end of at the year end. The project will commence on 1st January, so that means the year end will be December 25 up to 2029. So we'll have to calculate NPV here. Workings. You just need this and that will give us the NPV. So we have the year end. December 2025, December 2026, 2027, 2028, 2029. That is the year. Give me the question again. Cash flows. So we need to have the cash flows. We have a column for cash flows. Do we have cash flows? Yes. In note number 3, we have annual sales revenue from the project estimated as follows. So we have the cash flows. We have a column for cash flows. Cash flows. Are they in millions, in thousands? They are in millions, so we have 3 zeros there. We have cash flows at the end of the year 2025, 26, then we'll have to discount these cash flows at the present value. All are lump sum, present value, interest factor. R, is it 10%? N. Note number, which note is it that we get the cost of capital? Is it 12 or 10%? Look at the question again. The cost of capital for both South Africa and Kenya is assumed to be 12%. So this is we discount at the rate of 12%. Then that's it. We'll have the present values. We have the total present values there. Then we deduct the initial investment to get the NPV. So what we get here will be the present value of cash inflows. Present value of cash inflows. That is what we want to work out. We deduct the present value of cash outflows. That will give us the NPV. So we need to have a working for a total initial cost. The total initial cost. So we have a working. This is the working 1. Working 2. Total initial cost. That initial cost. What is the total initial cost? The initial capital, how much is it? Give me the question. That is the initial. Look at note number 1. The project will commence on 1st January with the initial capital of 5 million. So that is the initial capital. So we have initial capital of 5 million. Then we read from the same note that which will be used in acquiring agricultural machinery with an estimated useful life of 5 years, not number 1, with 0 salvage value. The straight line method will be used. Now in note number 2 we read, to enable the farm pay land rates and other working capital requirements, an additional 2.5 will be required, and it is expected that this amount will be recouped in full at the end of the project's useful life. So we have additional working capital, additional working capital of 2.5, giving us a total of 7.5. You see that? John, you see there is an additional cost, and that is in rands. These are rands, not shillings. These are rands, not shillings. South African rands. So the total initial cost will be how much? So candidates, you can see the 7.5 is in rands, yet we are to calculate the net present value of the project in Kenya shillings. Therefore, we have to convert the 7.5 million rands into Kenya shillings, and you can see the exchange rate in note number 5, please. Note number 5, the exchange rates between the Kenya shillings and the South African rand is as follows. 1st of January is 8 shillings per rand. Is it 8 shillings per rand, or is it 8 rands per shilling? Which is which? 8 rands per shilling. So when you are to convert the 7.5 rands in Kenya shillings, what do you get? So if 1 rand let's check if your figures are correct or not. If 1 rand is equivalent to 8 Kenya shillings. If 1 rand is equivalent to 8 Kenya shillings, if 1 rand is equivalent to 8 Kenya shillings, therefore 7.5 million rands. Therefore 7.5 million rands will be equal to the 7.5 will be equal to, let's confirm your figures, will be equal to the 7.5 million rands over 1 rand times 8 Kenya shillings. So that cancels with that. So 7.5 times 8, is that what you are getting? 60 million. So the total initial cost in Kenya shillings, total initial cost in Kenya shillings will be equal to, did you say 60 million? 60 million, that is 7.5 times 8. Question is easy, isn't it? It is not. So that is the initial cost. That will be our initial cost. So this is the initial cost. 60 million. So we need to calculate the present value of the cash inflows. All right, and this is the formula for calculating the cash inflows. So our next working, the third working, is to calculate the terminal cash flows. Terminal cash flows. Terminal cash flows. What will be received at the end. Look at note number to enable the firm pay note number 2 land rates and other working capital requirements an additional 2.5 million rands will be required, and it is expected that this amount will be recouped in full at the end of the project's life. So that is one element of the terminal outflow, working capital recoupment. So we have working capital, recoupment of 2.5. That will be recouped at the end of the project. Salvage value, we have salvage value. Salvage value is equal to 0. So the total is 2.5 million. That is the terminal cash flow. And this terminal cash flow again is in rands. It's in rands, not shillings. 2.5. Do you see that? Terminal cash flows 2.5 rands. Then there is a salvage value is 0. Then again we need a working for the depreciation, because that will help us in calculating the estimated cash flows. What is depreciation per annum? Depreciation per annum, we know, is equal to the cost minus salvage. It is straight line over economic life. Depreciation per annum. Depreciation per annum, we take the cost of the machine. It's 5 million rands. This is 5 million rands minus 0 divided by the number of years 1, 2, 3, 4, 5. So therefore, what is the depreciation per annum in rands? 5 million divided by 5, that is just 1 million. This is 1 million. That is depreciation per annum. That is working number 4. Then working number 5, we need to estimate the net cash flows. The net cash flows. We need the net cash flows. Then we discount the net cash flows to get the present value of cash inflows. So we have the cash flows, the revenues, the sales. You can see the revenues are in rands. So we are going to have the working for the net cash flows. Let's work it out here. Number 5, estimation of net cash flows, and there are 5 years: 2029, 2029, 2028, 2027, 2026, 2025. What is the sales for 2025 from the question? Sales value from the question. That is not number 3. You can see you have annual sales revenue 2.6, 3.5, 5, 4.2, 2.8. So sales in 2025 is 2.6, 3.5, 5 million, 4.2 million, then 2.8 million. So we deduct the variable costs, less variable costs. Do we have variable costs, or we need a working for variable costs? Working for variable costs. In note number 4, we did variable operating costs are expected to be 20% of the sales. So what is 20%? So we'll have a working for variable costs. Variable cost for 2025, 20%. Is it 20 or 25? It's 20% of sales. So it's 20% of 2.6. How much is it? In 2026, again 20% of 3.5. How much? 2027, 20% of 20% of 5 million. How much? 2028, 20% of 4.2 million. How much is it? 520. This is less variable cost. So if this is 520, then what will be the contribution? Deduct the variable cost from the contribution. Give me the from the sales. Give me the contribution. 700. Deduct 700 from 3.5. That will be 2.8. Then 20% of 5,000, is it not just 1,000? 4,000. 20% of 4.2, that should be 84. Is it 84? 840. Is it 840? It is 840. Yeah, 840, then 500. 500. So give me the contribution for each year. And these are runs. Runs. Contribution 2025. 2080. 2028, that's 360. 2029, As you are doing contribution, then we can deduct the fixed costs from contribution. Fixed cost, deduct the fixed cost from the contribution. The fixed costs are given in the question. 600 deduct 780 deduct 905 deduct 880 deduct 450 deduct. All right, we deduct. But there was also depreciation. Let's just also deduct depreciation. What was the depreciation? Depreciation. Deduct depreciation. We had calculated depreciation at 1,000 per month per year. This is 1,000. 1 million. 5 million minus 0 over 5 is 1 million. So deduct 1 million. 1 million. Is it so? 1 million. 1 million. 1 million. To give us a profit before tax. Profit before tax. You've not given me the contribution for 2029. Contribution to 2029. What is the contribution 2029? Contribution 2029. So that is profit before tax. Profit before tax. Then do we have tax? What is the tax rate? Tax rate. John says 2240 is the contribution 2029. 2240. 2240. Now give me the profit before tax for the 5 years. 2025, what is the profit before tax? The tax we read from the question, the tax rate is 30, not number 8. Assume that the corporation tax rate in South Africa is 30% and no further taxation will be applied in Kenya, will be levied in Kenya. Contribution varies with mine. 2029, how much is yours? 2029. What is the contribution? Even without a calculator, if you just multiply this 28 by 2, this should be 56. 28 times 2 is 56. Maybe that's where you are getting it wrong. So give me the profit before tax for 2025. You took 2,500. The sales for 2029 is 28. This is 28. 28, not 25. 28. For 2025, how about 2026? 2026, what is the profit before tax? 1020. The tax rate is 30%. 2027 profit before tax, Gapno says 2095. 2095. 2028 profit before tax, 1480. Give me profit before tax 2029. Profit before tax 2029. apply the tax rate on each. Tax rate 30% of 4080, 30% of 1020, 30% of 2095, 30% of 1480, 30% of 790. What's the tax? Profit before tax, apply the tax so that we can have the profit after tax. Profit after tax. Then on profit after tax, we add back depreciation. Add back depreciation of 1 million. Add it back. Add back depreciation. 144. When you add to 1000, you'll have 144. That is 2025. Give me profit after tax 2026. Is it 4080 or 480? Because 2080 minus 1000, that is 1080. 1080 minus 600 can only be 480, not 4080. This should be 480 if I'm not wrong. It should be 480 if I'm not wrong. I'm not wrong. Is it 480? So 30% of 480 is 144. 144 deduct from 480. What do you get? It's less than 400. That is profit after tax. The tax is 144. The tax here is 144. So profit after tax should be 480 minus 144. And it is 633. So add back depreciation. You'll have 1336. Says here 1714. $2027 says is 2466. Then 2036. Please check your accuracy. 306. So 306. It's 306. That's what you mean, Governor? 628. 628. Then 2028. It is 628.5. 444. 444. In 2029, it's 237. Am I picking the right figures from the chart? So what will be the profit after tax? 336. 336. Profit after tax 714. 714. All right. 2027. 46.5. 1466.5. 2028 1036. Then lastly in 2029 553. So we add back the depreciation. We can also add the terminal. We add the terminal cash flow. Terminal cash flow, so it's recouped. 2.5 runs. Terminal cash flows working number 3. 2.5 million. 2.5 million. So we can add back all that. So these are the net cash flows. Net cash flows. That is 1336 in 2025. In 2026, 1740. Give me the values for the other years. 2036. Don't round off. You are adding back. You are adding back. You're just adding back 1,000. You are adding back 1,000. You are adding back 1,000 here. This will be 24 without using a calculator. Just 24. 66.5. Why are you rounding off? Yet we have 3 zeros at the top. $24. Then for the last, no, you can also, you are using the figures in millions. We have 3 zeros at the top, and we already have we have a 0.5 here. If you have a 0.5 here, this is 1,466,500 because of these 3 zeros. So you cannot round off and say you are working in millions. If you do so, you have erroneous figures. And give me the total here for 2029. Just 553 plus 1,000 plus 2.5. This is 3.5 plus 553. How much is it? $40.53. Now these are the net cash flows in rands. These are rands. So we are required to convert these rands into Kenya shillings before plugging into the other working here. We need the net cash flows here in Kenya shillings. Then we discount the Kenya shillings to get the present values, so that we will have the present value of cash inflows, which we are going to insert into this formula to allow us have the NPV. So we need to convert the rands, and from the question you see, candidates, that the exchange rates are different for each year. Look at note number, which note is it? Note, the exchange rates in note number 5. The exchange rates between the Kenya shillings and the South African rand are as follows. So the exchange rates are given. December 2025 is 8.15. In 2026 December is 9. 27 December 9.5. December 2028, it's 10 shillings. It is exchanging at 10.3 in 2029. In 2029. So we have to translation of net cash flows from rands to Kenya shillings. This is working number 6. Translation of rands to Kenya shillings. That's our working. We have to convert this into Kenya shillings so that we insert here. So the first year is 2025, 2026, 2027, 2028, 2029. The exchange rate 2025, the exchange rate in 2025, and it is December. We read that these cash flows are received at the end of the accounting period. So at the end of 2025, the date here is December 2025, and it's exchanging at 8.5. But first of all, we need to have the cash flows, because these are years 2025. Then we have the cash flows in rands. So the first one here is 1336. Next you have 1714. Then you have 2466.5, 2466.5. Then you have 2036, and then 4053. The exchange rate, Kenya rands, South African rands, Kenya shillings. We have it from the question here, 0.50, 9.0, 10. Then we have it exchanging at 10, then 10.30. So the net cash flows in shillings. The net cash flows in Kenya shillings, we just multiply these two. Multiply the two. That is 1336 times 8.51. Give me the Kenya shillings. Here you'll have 1714 times 9. Give me the Kenya shillings. 2466.5 times 9.5. Give me the Kenya shillings. Here we have 2036 times 10. I know here this is 2360. 2360. Easy to multiply this. Then 4053 times 10, 30. 4053 times 10.3. How much is it? Then we write here. Kenya shillings exchange translation from rands to Kenya shillings 2025. I'm waiting for your answers. $11,356. Someone says 11,356. 11,356. 11,356. This is 20,360. 2026. 15,426. 15,426. 2027, 24, 23, 431. 23, 431 point something. 0.75. Give me the last year. What is the Kenya shillings? 41,745 point something. 0.9. This 0.90. Can we have the present value interest factors? 12% 1 year, 12% 2 years, 12% 3 years, 12% 4 years, 12% 5 years. I'm waiting for the present value interest factors. Present value interest factors. Present value interest factors. That is just 1. Is it 1 over 1.2 raised to 1? Then 1 over 1.2 raised to 2, 1 over 1.12 raised to 3, 1 over 1.12 raised to 4, 1 over 1.12 raised to 5. Should be 0 point something. 0 point, 0 point, 0 point, 0 point, 0 point. With the product of the cash flows and the present value cash flow, that would give us the present values. 89.29, 79.72, 4 years, 63.55. 63.55. Then lastly, it should be 0.5 something. 56.74. 56.74. Multiply the present value interest factors with the cash flows to get the present values. Present values. 2025, what's the present value? 2026, what's the present value? 2027, give me the present value. 2028, got the present value, and 2029, what's the present value? Then get the total. That will be the present value of cash inflows. From the present value of cash inflows, we are going to deduct the present value of the cash outflows to get the present net present value. This is Kenya shillings. 10, 139 point what? Did I see 772? 772. 10, 139, 772. Correct. Next, 12 to 97. 12 to 97. Did I see 206.206? 607. 607. 607. Next, 16,678. 16,678 point something. 719. 719. 2028, 12,938. 12,938.78. Fifth year, what is the present value? 23,686. 23,686 point what? 0.624. 624. Give me the total. Total present value, cash inflows. Then we'll advise. We want to advise the company, because you read that Mavuno Bora Limited is an agro-based company incorporated in Kenya. The company intends to invest in a capital project which will be based in Cape Town. So should this company invest or not? We have to calculate the present value. The net present value, if it's positive, the company can invest in Cape Town. But if the net present value is negative, then this company should not invest in Cape Town. What is the total present value from year 2025 to year 2029? Then we deduct the 60 million to get the net present value, which can either be positive or negative. $75. Someone says 75. 741. 75, 741. 75, 741. 0.5 or 3. 0.5 or 3. So this is 75 Kenyan shillings million 741,503. So 75 minus 60, that is just 15. 741 503. That is the NPV, and it's a positive NPV. Roman 2, advice. What is the advice? Mavuno Limited was considering doing what? Investing in a capital project? Yes. It was considering, look at the route. Mavuno is an agro-based company in Kenya. The company intends to invest in a capital project which will be based in Cape Town. So the management of Mavuno should invest in the capital project. Should invest in the capital project in Cape Town, South Africa. Why? Because the project will yield a positive NPV of 15,741,503. That is the positive NPV. So, any question? We've done August 2024. Thank you. God bless you. Bye-bye.
Number two, number two, we have ratio analysis. So when talk about the ratio analysis, as the name suggests, this is basically a tool of analyzing the financial statements, and it involves computation of ratios. Or this tool entails computation of what we refer to as the financial ratios. What is a financial ratio? This is basically a relationship between two or more financial variables. For example, in this case, as a financial analyst, you can express the profit reported by the company, or maybe the net profit or the operating profit, as a percentage of the company's revenue. So whatever you get, which automatically will be a percentage, is a financial ratio. And basically it shows the relationship between the operating profit or the net profit with the company's what? Revenue. So therefore you can say financial ratios is the relationship between two or more financial variables, Financial variables are those items which are included in the income statement, items of revenue, expenses, asset, liabilities, or what? Equity. Now, we have various ways in terms of these particular ratios may be used by various users. So therefore, you can look on the uses of ratios. Or uses of financial ratios. And even before you look on these uses of the ratios, it is important here to note that we have around 5 categories of ratios which may be computed using the information in the income statement and the statement of financial position. We have the profitability ratios, liquidity ratios, efficiency or activity ratios. We also have the solvency or capital structure ratios and the investment ratio. So therefore, what we are going to do here, we are going to look on what is the uses of those 5 categories of ratios. So let's start by looking on the uses of the profitability ratios. Now, these particular ratios here are used in terms of measuring the performance of the company's management, because in this case we say that if the company is performing well, then that is as a result of the good performance of what? The company's what? Management. So therefore these ratios we can say they measures performance of company's management. If a company is performing well, we have said that will be as a result of the good performance of the management. If the company is not is performing poorly, that we can also say it is as a result of the performance of a company's management. Then we also have the other category of ratios, and that is liquidity ratios. So how do we use these particular ratios, or how are these particular ratios used? Liquidity ratios, these are ratios which are computed. We're going to look on various types of liquidity ratios, and they are used to do what? To measure the ability of the company to meet the short-term financial obligations as and when they fall due. These ratios are computed to determine whether the company will be in a position to pay the short-term debts as and when they fall what? Due. So therefore this one measures ability of a company to pay, or in other terms we can talk of to meet short-term financial obligations. Short-term financial obligations. So will a company be in a position to pay the short-term financial obligations as and when they fall due. Short-term financial obligations, basically we are talking of payment which are supposed to be made to the creditors and basically the other who suppliers. So the company will need to compute now the liquidity liquidity ratios. So then from there we have the other category of ratios. So number 3, we have the efficiency stroke activity ratios. And these ratios, on the other hand, are computed to determine how well or how efficient the company is using its assets or its resources to generate revenue or basically to generate profit. So we can say the measures the efficiency basically efficiency, we are talking of how well the efficiency of a company in using its assets to generate a profit. How well is the company using its assets to generate what? Revenue. And then the other category of ratios is the solvency through capital structure ratios. Now these ratios, on the other hand, are computed to determine the ability of the company to pay or to settle the long-term debts as and when they fall due. They measure the ability of a company, to meet long-term financial obligations. So these ratios are computed to determine whether the company would be in a position to do what? To pay the long-term financial obligations, e.g. the loans which have been acquired by the bank as and when those particular loans fall due. Then we have the last category of ratios, and that is the investment ratios. They are also known as the equity ratios. Now these ratios are computed to help the shareholders of the company, or basically to help the equity shareholders of the company in terms of doing what? In terms of evaluating how well the investment in the company is performing. As a shareholder, once you invest there by buying shares, you want to know how well your investment is performing. So therefore we can say the help equity shareholders to evaluate performance of the investment. Evaluate performance of the investment. So therefore we have those as the 5 category of ratios, and basically the uses. Okay, so then from there we